He's been teaching behavioral finance and business valuation at various schools for last 25 years or so. Earlier teaching with the MDI and now with Flame. Also, he's one of the few people who's not just a academician, he's also a practitioner of the art of investing, which is very rare. He's also a partner and founder of ValueQuest Capital LLP, a SEBI-registered investment advisor. The talk today actually reminds me of an event that we did about 11 years back. I think it was 4th March 2012. And it was one of the first events that we organized in Delhi chapter. Yeah, here's the picture. So you can see, I think Prof was my age at that time, if I'm not mistaken.
I don't know.
So that was a long time back. Just one interesting tidbit about this is that since it was one of our first events and we didn't have too many members in the chapter, that day we had to call people to remind that there is an event, please come. And it was probably a room which was 1/4 this size, and there were a lot of empty seats. We could, I think, get about 15-20 people from the member base, and they were like total 30 people. I think you have that picture as well. And half of them were his guests and friends. So we've come a long way from there, and you will see during the rest of the day, this room will be full, and maybe there will be some people standing. Those were the early days of the chapter, and after that we've hosted him for quite a few events, and every time we get to learn something new. In fact, a lot of new stuff, because he keeps on upgrading himself, he keeps on learning and teaching us. And coming back to the event today, in fact, the last event I'm talking about of 2012, I think this will be probably a sequel to that event, because that event was titled 4U's. Now we have RRR movie, but that time we coined the term U, which was understanding the universe of unknown and the unknowable. And amongst other things, Prof talked about a seminal paper by one professor, Richard Zackhauser, who's an economist and a Harvard professor, on investing in the unknown and the unknowable. And that paper has given a lot of insights, and he covered some of them. And I'm pretty excited to know that after 11 years, what else he has to talk about from that paper. Join me in welcoming him with a big round of applause.
Thank you. Thanks, Jitin, and thank you for, good morning to all of you, and thank you for inviting me to do this. And as Jitin mentioned, this is going to be, I've been here many times before. In fact, this is my 8th talk here at CFA Society in India. And the previous talks are listed over here. 12 years is a good time to have a sequel, right? So if you look at the titles of the various talks that I've given, you found hopefully a pattern, basically, that I'm deeply interested in the process of investing. It's called thinking about how people think about investing, and not just about investing, but also from how people think about businesses. So the talk is, as the title of the talk is, for business analysts and value investors. So how people should analyze businesses, how they should think about investing, and specifically value investing. There are so many styles of investing, but I'm a value investor, and I bring to the table here whatever I've learned over the years about value investing. In fact, only my style of value investing, there are so many different styles of value investing. We have very accomplished value investors in this room as of now. Safir is sitting right in front of me. He's a remarkably versatile investor, because he is truly multidisciplinary. He's done so many things in different fields. We have Donald Francis somewhere in the room. Donald is the founder of Value Picker. Many of you know him. And like me, he's also deeply interested in the process of investing, how to get better as investors and be more collaborators. He also believes in the idea of sharing knowledge and experiences, and so he's got a wonderful network of friends with very similar mindsets. Many of them are close friends of Safir as well, mine as well. So it's a good network to have. So the process of investing is very fascinating, and as you can go down the list, there are so many things that I've talked about in the last 7 talks, and today is the 8th one. And indeed, it's not just the talks that I delivered at CFA Society, but also elsewhere. If you look at some of the other talks that I delivered at Money Life, for example, there were 4 talks that I've given. They are all about certain aspects of investing, certain aspects of business analysis, and how this works, and what you can learn. And some of these ideas are very academic. I'm a part academic, so I do think that wisdom is hugely academic. All the best ideas are out there, and people don't apply them very well. Simple ideas from mathematics, like the probability. We'll talk about a little bit of that today. And then October Quest is another forum where I talk over the years. This was, of course, in Parag Parikh fund. And again, you can see here, worldly wisdom in an equation is a title which I picked up about the Bayesian reasoning, and it's a mathematical equation. It's been around for like more than 300 years. But the ideas in those, how to apply those ideas in a practical sense, is what my interest is, and that's what I try to learn and show to my own students over the years. And this is not an exhaustive list. Over the years, I've done many talks at various forums, including at MDI, where I was teaching for more than 21 plus years. Now I'm doing it at Flame University. So the process of business and investment analysis is of deep interest to me. Like this one, today's topic is also based on that. Today's topic, which is basically maxims for thinking analytically. Again, as you will see, this particular understanding the universe of the unknown and the unknowable is based on a paper which was titled Investing in the Unknown and the Unknowable by Richard Zeckhauser. This title, Maxims for Thinking Analytically, is actually the exact title of a book on Richard Zeckhauser written by another professor who has Dan Levi, who conducts one of the most popular courses in statistics in Harvard University. And he is a student of Richard Zeckhauser, and there are so many other students, and some really accomplished people around the world have gone and done wonderful things, and they've learned and they've applied these maxims. So basically what Dan did was he went to all these people, he asked them, what have you learned from Richard Zeckhauser over the years? And he made a book out of it, and that book is called Maxims for Thinking Analytically. So it's all a collection of those various maxims that people have actually assimilated and applied. And the interesting thing is that there is very little discussion on markets and investing and businesses in the book. So that's not what the book is about. The book is written by people who are doing political analysis and people who are economic advisors to various governments and people who are actually involved in running governments and so on. But Richard Zeckhauser's maxims are applicable in so many fields, including our field. So what I bring over here is my understanding of those maxims and how we can apply them, how we can contextualize those maxims in our own field, which is the field of business analysis and investing and value investing. So that's what we're going to do over here today. One of the advantages of having a session like this, which is only for me and not future speakers coming, is there is no deadline. Now, I hope you will be here for a while. I don't know how long this will last. I have 146 slides. I'm on slide number 5 right now. But typically, when I'm teaching at Flame University, first 3 hours go in just warming up. So I'm not scaring you. It's a Saturday. I know you'll be free by about 2 hours or so. So let's start. So this is the guy we're talking about. He's a highly respected professor at Harvard University. He's also a champion bridge player. He plays bridge, and a game that requires thinking in treating the world as a probabilistic place. And dealing with uncertainty. So that's what the game is about. That's what life is about. That's what investing is about. That's what business is about. And this is the field in which Richard Zeckhauser has built his reputation. So I actually learned about him for the first time from Charlie Munger, and this is what he had to say. He basically used to play bridge along with Richard, and he really liked the way Zeckhauser thinks. So he made a reference to Richard Zeckhauser. And obviously, when Charlie Munger talks about a person and he says that you should learn from him, become a role model, you want to do more work on him. So I deep dived into the works of Richard Zeckhauser back in 2010, 11, and then 2012, I gave that talk on understanding the universe of the unknown and the unknowable. This was that talk, as Jitin was mentioning, sometime in March of 2012. It was based on this super paper. Everybody should read this paper, by the way. If you haven't read this paper, please read this paper. It's available for free. Just Google it and you will get it. And you will find some very interesting insights in that paper. You will be able to relate to a lot of the things that you have done yourself as investors in your own journey as investors. This talk was based on distinguishing risk from uncertainty and converting uncertainty into a friend instead of an enemy. So one of the most important things that come out is risk is not the same as uncertainty. We intuitively know that. Many of you know that already. Those of you who study Warren Buffett or Ben Graham or other value investors. Risk is about probability of impairment, probability of a permanent capital loss. Uncertainty is about things that you don't know, how things will happen, variability, uncertainty. And of course, academic economics treats the two as the same, which is the fatal flaw. They treat the more uncertain things are the more risky they are, but that's not necessarily the truth. Deep thinkers like Charlie Munger or Warren Buffett or Richard Zeckhauser and so many others are very careful to distinguish between these two terms, risk and uncertainty, and it comes out very well in this paper. I'm not going to talk a lot about this paper because there are these maxims that I have to cover, which will take most of the time. But this paper opened my eyes in many ways, especially when I combined. One of the things about being a teacher and a reader of various thinkers in the field in which you're operating is that you end up synthesizing ideas. So when I read this paper, I say, hey, this makes sense, but I can combine this particular point that he's making with something else that I learned from Ben Graham or from some other teacher of mine, and then this is how I would think about this. So that synthesis is very important way of building your own knowledge base. So that's what I had done in that talk. I had synthesized ideas from Ben Graham and from Richard Zeckhauser to come up with some thoughts about how to go about looking at a world as a value investor and how to turn uncertainty into a friend. And I'll expand more on that as we go along. There's another book which I want to talk about today, of course, which is the Maxims for Thinking Analytically. This is the book that I was referring to. It came out in 2021, and I immediately wanted to read it because it was on Richard Zeckhauser, who is one of my heroes. And it takes a while to understand and digest this book and marinate it in your mind and then come up with ways in which you can implement it in your own field. As I mentioned earlier, that this book is not about investing primarily, it's not about business analysis, but everything in the book can in some way or the other be applied to our field. And it quotes, Dan Levi quotes dozens of Zeckhauser's ex-students on what they learned from him, and he ends up with 19 maxims. So combine them into 19 maxims. These are those maxims. As you can go down the list, I'm going to cover most of them, not all of them. I'm going to cover 12 of these maxims and contextualize them for you, business and investment analysts. Now, while I do this, I will not limit myself to what this book says, but also will synthesize ideas from some of my other teachers and my own experiences. Experience is a good master, as we all know. I will also use material from another excellent book, which I highly recommend, and that's the book which I want to recommend to you is this one, The Upside of Uncertainty. And Basically, this book basically says that there is a huge bias against uncertainty. People are scared of uncertainty, and there's no need to do that, by the way. You can turn uncertainty into a friend. By the way, this book was published in July 2022, only a few months ago. It does not even mention Richard Zeckhauser, which is surprising, but it contains many ideas that he would endorse. Thanks. Indeed, long before this book was published, in 2010, Professor Zeckhauser published an excellent paper on the subject, and he called it Blindness to the Benefits of Ambiguity. Benefits of ambiguity. People are blind to the benefits of ambiguity. He said that in 2010, and this book is talking about in 2022. It doesn't make any reference to this paper or anything that Richard has done, but this is all Richard has done all his life. It's surprising that the book is lacking, but that doesn't mean that you shouldn't read the book. It is an excellent book. It tells you how to think about uncertainty, how to turn it into a friend, and I really enjoyed reading that book. In this paper, Blindness to the Benefits of Ambiguity, Zeckhauser discusses how decision makers often neglect the benefits of ambiguity when making decisions, and how this can lead to irrational decision making. He provides examples of situations in which ambiguity can be beneficial and discusses how these situations are similar to real world situations. So now we can just deep dive into Maxim. And as we go down that path, I'm reminded about what's happening in our world right now. There is this group of business which is stock prices are being hammered. We are talking, of course, about the Adani Group. And I was reading 2 days ago that their overseas bonds are trading at a deep discount to their redemption or par value, and the yield to maturities have gone up to 30-35%, way above. They're selling like junk bonds. And so there is uncertainty. This is exactly the kind of uncertainty that was attractive to investor like Ben Graham. If you read his books, he talks about that a lot. And he says, yeah, sure, this is maybe allegedly a fraudulent company, and there is this huge report that has come out, and there is this stock which is getting hammered. But your job as a potential investor in these bonds is not to worry about those things. Your job is to worry about whether are they going to meet the obligation or not. When is the obligation due? How far is it? How much money do they have in the bank? What are the covenants? How much what is the actual risk in this situation of your impairment from here? If you buy something at 70, which is potentially worth 100, even if it goes to 90, you still make a big return over a 7-8 month period. So a lot of the things that you would think about are things that are important to that understanding that specific situation, even though it may turn out that the allegations are true and the stock's probably go to zero, and all of those things may turn out to be true. But that doesn't have to happen in the next 6 months. Both things could happen, that they will meet their obligations and the stock could go to zero. But that doesn't mean that you should run away from this situation simply because there is fear. There is fear about this particular situation. Again, this is not the way how I invest, but I want you to appreciate how people who run towards uncertainty, treating it as a source of opportunity, think about these situations in a very probabilistic and a very systematic manner. How do they analyze these situations? This is what this talk is about. Maxim 1. And there are I'll do about 12 of these 19 maxims. And by the way, some of these maxims are about life, how you should lead a very happy life. So those are also very interesting. On a personal level, I won't have time to talk about them, but I think you should read those too. So the first maxim is about when you're having trouble getting your thinking straight, go to an extreme case. Extreme cases are very instructive. Extreme success, extreme failure. We all know about the famous dictum that all I want to know is where I'm going to die, so I never go there. Figure out ways in which businesses fail. What are the typical things that people do to blow up their companies? And just don't do those things or avoid those situations. Studying extreme failure is a very instructive way of learning about what does not work and therefore how it must be avoided. Likewise, extreme successes. So extremes are important. So in that sense, from a business analyst point of view, studying extremes is very important. So instead of picking up what to study, why not pick up things that have worked very well or have blown up very badly and figure out what are the causal factors, what are the common factors, and are they there elsewhere. So it's a lot like pattern recognition. Basically, you're asking two questions. Have I seen this before? If I have, then how similar was it to this particular situation? What are the similarities and what are the differences? Are there lessons that I can learn from what happened in the past? Is the same thing going to happen again? History repeats. Not exactly like they say, it rhymes. So there are so many things to be learned from studying extreme successes and extreme failures. Now let's talk about investing. Similar to analyzing businesses about successes and failures, there is also extremes in valuation, right? So we have extreme valuation, extremely low valuations, and we have extremely high valuation. And one of the most important insights of being a student of Graham that I have picked up is that he hardly ever talked about actual value of a stock. He only talked about notions that the value is probably much higher than the price that I'm paying, margin of safety. It's worth a lot more than what I'm paying, or it can't be worth less than this number. So he didn't want to get down to predicting. He didn't, as we never did DCF or any of that stuff. He sought protection over price paid, in terms of that there is no way that this business or this stock or this instrument that I'm buying could be worth less than this, less than 30, and I'm paying 20 or 15 or even 27. It's worth a lot more than that. So the gap between perceived value and the market price is the source of margin of safety. So how did he come up with those notions? What were those things that he did? There are all sorts of ways of thinking about it. Let's talk about first extremely high valuation, and we see a lot of that. We saw a group just now getting hammered. Some of the stocks were selling at 1000 P multiples, right? Insane. But the insanity continued. If you thought that it was expensive at 200 P multiple and you thought that if you short the stock, you would have got burned, because you see what happened to that. So extremes can go on for a long while, and we know that. But if you study history of finance, in the history of financial markets in particular, you will find that extremes happen on both directions. Extremes can last for a long time, but extremes don't last forever. So these three things are important, which means that you know what's going to happen, but you don't know when it's going to happen. So don't try to predict that this is going to collapse tomorrow or this is going to go up tomorrow. You don't know. In the long run, the markets are roughly efficient, but that long run could turn out to be very long term, and it could really tire out people, and you may not be around to enjoy the benefits of good thinking and so on and so forth. So let's talk about extremely high valuation. And one of the things that you pick up in mathematics is the idea of proof by contradiction. And we all studied that when we were in school. How do you prove the square root of 2 is an irrational number? How do you do that? So you assume that it's a rational number, and if you then continue with the argument, you demonstrate that if it was a rational number, it will lead to some absurd outcome, and therefore it can't be a rational number. So therefore you assume that a proposition is true, and then show through logical reasoning that if that proposition is true, it will lead to an outcome that is obviously absurd, therefore the proposition must be false. It's ridiculous or absurd or has some impractical conclusion. And I don't want to deep dive into this. These are all maxims. I want to just give you a general idea about what these maxims are about and how to apply them, because I have done detailed lectures on this subject where I actually demonstrate these things on a practical sense, but I will just talk about those examples briefly. So one example is how Buffett talked about the absurdity of dot-com valuation in 1999 and early 2000, and he talks about it during the AGM of Berkshire Hathaway in 2000 when dot-com bubble was at the peak. And basically he says you just think like a businessman. One of the key lessons that you pick up when you study value investing is that a stock is not a piece of paper, it's a claim on a business, and you should, if you are not going to buy the stock for $10, you shouldn't, if you're not going to buy the business for a $10 billion valuation, you shouldn't buy the stock for $10 valuation either. So you think that like a businessman, and you ask yourself a very simple question: will I own this business? Will I buy this whole damn business at this current market valuation? The market cap is available to you. Let's imagine that you were in a position, you had all the money in the world to buy the whole business, and then follow through as to what that means. Then if you think like a businessman, then you want a return on your investment, right? You want some returns on your investment. What should those returns be? Obviously, they should be more than the fixed deposit rate, right? Obviously, they should not be so high that will treat you as a very greedy person. So think of a number, whatever the number is, and it's not important. It has to be a rational range of numbers. So let's say it's twice of AAA bond yield. If bonds are yielding 6%, you want to earn 12% on your investment, right? So you need to earn 12% on a $100 billion investment that you have just mentally made, because this business is selling at $100 billion valuation, which means the next year it has to deliver earnings of $12 billion. But it isn't, because it's a growth stock. It doesn't have much of earnings right now. It doesn't have much of revenues either. This is .com era, remember? And yeah, sure, it's possible that a business may not be earning anything right now, may not be having any revenues right now, but could still be worth a lot of money, because there is so much more money to be made into the future, and in present value terms that number will be large, sure. But for every year that you don't make the $12 billion, you should make more in subsequent years to compensate for the years in which you did not make the $12 billion, right? So you make the calculation. How much money should the business make in year 10 to justify the valuation at which you are buying the stock right now? The $10 stock that you're buying right now, which implies a $100 billion valuation, how much earnings as a normal, reasonable businessman or businesswoman seeking a 12% return on investment should be, how much should the business be earning, compensating for earnings not made in previous years? How much should be the terminal earnings in year 10? You can figure that out, right? Very simply. But that's not where it stops. So once you have the earnings number, you can then move up. You can move up the P&L. You have the earnings number. How much earnings are required to be? Earnings required to justify valuation is a very important concept to keep in mind. So once you have that number, you can move up the P&L to figure out what the revenue should be, because you know what the margin profile is, you know what this industry is about, you know how much money is to be made, and you can make your reasonable assumptions about those things, but you come up with the revenue, gross revenues that the business would need to generate in year 10 to produce these earnings in year 10, which would have accumulated to a large number, and then there will be more earnings beyond that, and when you bring them all to present value, you get $100 billion valuation. But you don't stop at the revenue number also. Then you move into the quantitative space. You know, how many widgets they have to sell, the typical average price at which they are selling a typical product or service, and what is the business volume. You're actually moving into now the physical part of it. How much business volume is needed to produce the revenues in year 10 and then they will also grow beyond that to justify the valuation of $100 billion today. It's a very simple logical step-by-step thinking, right? Assume that the $100 billion valuation is correct. If that's correct, then year 10 they need to have something like how many billions of dollars of revenue and how many millions of units of products that they would have to ship. That will give you some idea as to what the size of the opportunity is and what should be for you. And often you will come to conclusions that there is no way this will happen. This is where the proof by contradiction comes. That there is no way. So for example, in 2007, wind energy was at the rage, and we had Suzlon, company selling at a 45,000 crore market valuation. At that time, it was considered insane. Today, $45,000 valuation, 45,000 crore valuation is not considered as very high today. But in 2007, it was extremely high valuation, and it was not just Suzlon, it was the entire wind energy space. So you could take the aggregate market cap of the wind energy companies and assume that you bought those businesses at the current market valuation, and do the same exercise that I've done and work backwards towards the required earnings in year 7, 10, year 7, 8, 9 or 10, and then work up towards the amount, how many megawatts of electricity would they need to generate, and you find that there isn't enough space in the world where you could install wind turbines where there is sufficient wind to deliver the megawatts that you need, the units of electricity that you need to deliver the business volume that you need, to deliver the earnings that you need to justify. Therefore, the whole thing is absurd. It's a simple technique that is taught in school. The funny thing is, one of my interesting insights about education is that we learn all these things in school. Proof by contradiction and reductionism and inversion, all these things we were taught in school. In doing algebraic equations, you take right hand side to left hand side and the other way around. But we forget about all these things. We don't think that they have immense practical utility in our own fields. So that was one example that you can use proof by contradiction. This is absurd, and it can be applied either ways. Harry Markopolos applied it when he exposed Bernie Madoff. He said that your track record, what you're saying that you're doing, is so consistent. What you are doing is incredibly consistent. You don't have, markets are volatile. You're operating in a volatile environment. How come you have such consistent returns? Something is wrong. You could immediately see, and he wrote long documents. I used to teach a paper on forensic accounting and corporate governance, and those papers were required reading. What submissions that he made to the SEC at that time, he made some 3 or 4 submissions with huge number of red flags. And one of the red flags was on options. So this guy was claiming that he's making all these money in option markets, but this Harry Markopolos, who's a mathematician, figures out that the money that you're saying you make in option market, there isn't enough volume in the entire exchange in this period for you to be making this kind of money. So you're a fraud. One of the red flags. There were 21 red flags. You often find that people try to demonstrate the absurdity of a situation by taking this extreme situation and then showing that it is extreme for all the wrong reasons. Reductionism is something that I mentioned. It's very simple. It's a technique that we use. But we can go beyond this. How do you reduce a problem to a more simple problem? As Munger has said, that you can never make any explanation that can be made in a more fundamental way. How do you get to more fundamental? And I actually demonstrated that to you. So in the example on Suzlon and the wind energy companies in 2007, basically that was the valuation problem. That's a social science problem. There's a problem about how people should value a business. But if you were to reduce that problem, like we did to the problem of physics, which is a more fundamental discipline, that there isn't enough space in the world which can have locations that will install sufficient number of wind turbines, windmills to generate the electricity that will produce the industry revenue and earnings that will justify this valuation. Then you reduce the problem to a more fundamental discipline, and that's a very elegant way of thinking, right? Reductionism. So try to do that. We get caught up a lot with the numbers and the promotional literature that the companies have sending out to us, the presentation decks and whatnot. But ask very simple question: is this true? How absurd this could be? What does this imply? If that implication that you are trying to derive is from a field, from a discipline, which is more fundamental than the discipline that we operate in, then you are getting wiser about the whole thing. On the flip side, I've done talks. In 2012, I did the talk in IIM Lucknow. I think you were mentioning that outside the room just now. Safir was mentioning. IIM Lucknow, I did a talk which became very popular. It is called Vantage Point. Basically, I took a very simple idea of Ben Graham that if there's a debt-free company which is amiable for debt financing, it has a stable business, stable cash flows, has no debt on the balance sheet, and if the stock is selling at below its debt capacity, there is a way to figure out how much debt a banker would give to this company without any problems against the security of the cash flows of the company. And then when you find that the stock is selling for less than the debt capacity, you've come to a proof by contradiction. There is no way it can be less than this, and you demonstrate that in many ways. You could issue bonus debentures, you could make the company borrow money and do a stock buyback. And there are so many ways in which you can say. Basically, the point to demonstrate was that hidden inside the earning stream of a company, of a debt-free business, is a bond component. And you can take out that bond component and put it in a different instrument, and you can list it in the bond market. The bond market will give it a valuation based on how they think about the safety of that instrument. And the whole stock, without the bond instrument ahead of it, is selling for less than the value of the bond component alone. And this is exactly what Graham said, proof by contradiction. There is no way a company, a business which has stable cash flows, where the debt capacity can be derived and the stock market capitalization of this debt-free company is less than this debt capacity is cheap. So it became a very interesting theme as such, debt capacity bargains, thematically. So again, Graham was not trying to demonstrate that this business is worth so much and so much. He was saying that it can't be worth less than so much. And to do that, he would say, there is this earning stream, take out the bond component, figure out how much debt this company can easily take. Start from interest coverage ratio. Give it an interest coverage ratio of 3x, 4x, 5x, whatever is suitable for that industry, and work backwards to figure out what based on prevailing interest rate, is the debt capacity of this company. If the bond markets will easily lend money to this company, why are the stock markets giving a valuation of less than this? So if 1/3 of the earnings are attributable to the bond component, and all of those earnings are capitalized in the bond market at $100 million, but all of those earnings are being capitalized by the stock market when there is no bond in it at $40 million, there is something wrong. One of the two markets are wrong. So basically, he used to talk about comparing bond market valuation, and a lot of investors that I know do this a lot mentally in their heads. Rajiv Thakur talks about closet bond investing, for example. So they're thinking like bond investors. They're thinking like hidden inside the earning stream of this company is a bond component. Let me take it out and give it a separate valuation the way bond markets will give. And then anything on top of that is the valuation on top of the bond valuation. It's a very elegant way of thinking about this, because what that means is that if you could get the business for less than the bond component valuation alone, then uncertainty becomes your friend. Because minimum value you already know. Now the other value, what Graham used to call it, a speculative value. Now I don't want to use the word speculation in a very derogatory manner, I'm not. There is intelligent speculation and unintelligent speculation, but he had a way to show you that there is this investment value, which is the bond value, and then there is this rest of the value, which is speculative value. The speculative value could become very large, or it could be worth zero, but you're not paying anything for that. If you think of it from that point of view, it becomes like a free lottery ticket. The speculative component becomes like a free lottery ticket. Then uncertainty is your friend. It doesn't matter. It's heads I win, tails I can't lose. So that's exactly how, when you combine these ideas from the founders of the value investing discipline with the ideas that I'm going to talk to you about, you come to some very interesting notions about how you can synthesize these things and turn uncertainty into your friend, especially when you have crazy markets. Markets do crazy things. Volatility is there. So you may end up getting growth for free. The growth component of value could come to you for free. And we know how to figure that out. And there are ways of doing that, very simple ways. I'm not going to spend time doing it today, but essentially you figure out that what would be the non-growing earning stream of this company be worth. So you remove the growth component completely. What would it be worth based at current interest rates? And then you find that the whole company is selling for less than that, which means you're not paying anything for growth. In fact, you're getting paid for growth. You clearly can see growth. You don't know how much it is. You don't have to. You can't quantify it. But clearly, you're in a growth industry, in a growing business. It could be anything. It could be unorganized to organized theme playing out. It could be the market growing itself. The market is growing at 7%, but the market is dominated by unorganized players, which is like 70% of the market share, and 30% is with the organized players, and your company is 20% of that. 2 out of 3 players is the largest player, and it's growing faster because it is taking market share from the unorganized. So 10%, 7, 8, 10% growth rate of the industry is there. Plus you're taking market share from the unorganized players for all sorts of reasons, GST, whatnot, scale economics. As a consequence of that, your growth rate, but you don't want to explicitly predict this much will be the growth rate in year 6, 7, 8. You don't need to do all that. This is what this kind of thinking does, is that, well, the growth is there. You have done all sorts of analysis to give you that this is a growth industry, growth quality is good, incremental returns on capital are excellent, they have reinvestment opportunities, and all those things are there. But you're not paying anything for it. That all of the current earnings of the company, the current earning stream of the company, even if it did not grow, is more than sufficient to explain the current stock price of the business, which will happen at high single digit multiples in today's interest rate scenario. then you are effectively buying into a growing business, a good quality growth business, which I will come to in a minute, but you're not paying anything for growth. And that, what does that do? We know that these things exist, but from an analytical point of view, what that does is it removes the need for you to make explicit forecast of what this earnings will be 5 years from now and 10 years from now. It removes the need for you to bring back to present value those future earnings stream. It removes the need for you to do all kind of scenario analysis, the kind of things that you see in a lot of these sell side reports, tables at the end. You don't need to do any of that stuff, because you are seeking protection from models that are elegant, that come from ideas proved by contradiction, instead of making elaborate predictions about what the future must bring in order for you to have a margin of safety. To be sure, growth stocks do that. Some people have the ability to show that the earnings of this company are going to grow, and even at 25 times earnings, it's a very cheap stock. Yes, those things occur, no doubt about that. But what I am mentioning here is that there are also situations where growth stocks are available at non-growth multiples, and that's the best time to buy them, because then you have two friends working in your favor. You have the growth of the earnings, and you have the possibility the market will recognize that this is a growth stock and therefore give it a higher multiple. So you have a multiple re-rating working in your favor. So you have two friends working in your favor: the growth of the earnings itself and the possibility, which may or may not happen. Even if it is warranted, it will happen. You cannot predict when it will happen, but at least you have two friends working in your favor, instead of only one friend. In fact, or one of them turning into an enemy when you pay 60 or 70 times earnings. Yes, you can make money in those situations, but you better be right about the growth going forward. If it turns out to be even less, it may turn out to be a solid growth, but it is not as good as is implied by that high multiple, you have an enemy on your hands. You're running up on a down escalator. You may see earnings growth, but a derated stock, and Safir has talked about it a lot in his tweets. If you follow some of his tweets, he'll tell you about those things. And so many others have done the same thing. He had other ideas like high earnings yield as compared to AAA bond yield. If you can find a business which gives you an earnings yield on a sustainable basis, just turn the P multiple upside down. And of course, you have to make modifications. The earnings have to be real. They have to be owner earnings, not cooked earnings, or even if they are not cooked, they are genuine, real, discretionary earnings, and so on and so forth. But there's a method for that. But once you get that, then it becomes easy for you to say, I can put money in a bond, and if I put $100 in a bond, I'll get $7 or $8. Or I can put money in a business, and if I put $100 and I'm getting $16 to begin with, and the earnings are going to grow. Which is a better business? A bond whose earnings are never going to grow? What will it look like 10 years from now? And if I do this in a number of situations, some businesses will not work out very well because the earnings will decline and there will be governance issues, there will something go wrong. But if I keep doing this over and over again on a portfolio basis, which of them are likely to give me a better outcome in the long run? And the answer is very simple. At the moment you start looking at it from a businessman point of view, if you have multiple businesses where your starting purchase price is as a percentage of the starting earnings as a percentage of the stock price or the market cap or the enterprise value is significantly higher than what you would have earned by putting the same money in a bond market, then you have a source of margin of safety and a earnings yield which is significantly higher than AAA bond yield. So I talked about this already, so I'll take that off, except that I add one nuance, and this nuance is what I call as kati patang. We've seen stocks go to incredible valuations. We have seen when you fly a kite, it takes some effort to fly a kite, but once it's there and there's wind underneath the kite, it will fly. And then if you have a long manja, if you keep loosening it up, it will go further and further and further. And then if the manja is cut for whatever reason, it can go higher and higher still simply because of the wind under the thing. So think of this metaphor that I think about is a business which is being appreciated by the markets was not so appreciated. It could be Page Industries at one time, it could be Relaxo at another time, it could be so many businesses that have got re-rated over a period of time. But beyond a point, it becomes like a kati patang. Because when you think of it from a business point of view, if you buy these businesses at the current re-rated valuation, then for you to make money, the multiple must not drop. Or even if it drops, it should drop much less than the earnings growth rate that you're projecting. So you have an enemy and you have a friend. But you don't know when that will happen. The kati patang, the outcome in the long run, multiples compress. In the long run, multiples have to come down to factor in forward earnings. No matter how far you look out, if 10 years from now the multiple is going to drop from 50 to 30, then you have a 20-point drop in multiple to fight against with earnings growth that you're projecting. So earnings growth might happen and still you may not make any money. You may actually end up losing money, which you call as time correction and whatnot. But the fact is that it is a kati patang. It is a kite that is flying and you don't know. A 30 PE stock could become 50, 50 could become 100, 100 could become, we've seen 1000 PE stocks in the recent past, which are now getting hammered. But who would have thought that this would happen? But it has happened. Look at Adani Green Energy, for example, a business which, or look at any of these, some of these businesses selling at really ridiculous valuations. They were ridiculous even at 1/3 of the current market valuations. Even? 1/10. Yeah, okay. Yeah.
This approach of finding undervalued stocks goes for free or this method. Today, is it also applicable for highly liquid and widely followed by sell-side kind of stocks, or only this?
Oh yes. Oh yes, there are prejudices. They may be highly followed. There are big companies out there with highly liquid stocks which are a huge prejudice because they belong to the government sector, for example, or they belong to a space where there is some prejudice, there's something terrible going on, or the industry is going through a terrible downturn and it's a cyclical industry. There are so many examples, but the answer to your question is absolutely yes, that it happens. Just because it is followed doesn't mean it is going to be priced appropriately. In fact, I see a little correlation between. There is some correlation in the sense that small stocks which have very little following tend to get mispriced more. But even large stocks, you find that a lot of that happens. For all sorts of, there are always reasons for that, of course. That people don't want to touch that space or that sector, or there is some reason, and the reason is often wrong, and that's what the game is about. Find a reason and then challenge the reason and figure out whether it is right or wrong. Second maxim, I put 3 maxims together here, and by the way, these are not in order. Some of the maxims which come later have the way I thought about them, maxim 12 is very well linked with some, like maxim number 7, put them together because I want to talk about them in continuation. Maxim 2, when you are having trouble getting your thinking straight, go to a simple case. 3, do not take refuge in complexity. And 4, when trying to understand the complex real world situation, think of an everyday analog. So let's look at each of these 3. Now the simple maxim that I follow, so there are many styles of investing. Some people want to do turnaround, some people want to do risk arbitrage, some people want to invest in better quality businesses, long-term compounders, some people are betting on event-based strategies, some people are betting into distress or opportunistic investing. So there are all kinds of value investing styles out there. But the one which I like the most, which is the simplest case, is basically compound interest inside a business, which basically is the idea that the business is able to compound its own capital at a high rate of interest. We all are familiar with compound interest, generally speaking, when FD rates, and if you compound your money at 12% versus if you compound your money at 11.5%, then the terminal value after 30 or 40 years will be very different. We all know that. But what people should also appreciate is that there is a compound interest inside the business, where the assets of the business are like the money, and then the earnings that are being earned on those assets is the earnings. So the higher the rate of return on those assets, the more the compounding effect is playing out, to be sure. So that's the simplest case that I like. So let me elaborate a bit on that combination. So you have high returns on capital, you have protected returns which could come from all sorts, and I'm not going to go into this because those are lectures by themselves. Each of the reasons that will protect those returns could be a source of durability. Safir can talk to you about intellectual property for 3 days, and then we'll have to pull him down and he'll still not be done. So that's just one way of protecting your returns. So basically what I'm saying is the simplest form of compounding capital in the field that I operate in, the way I look at it, is that there is already a business, it's been around for a long time, it already earns high returns on capital, and the returns are protected for all sorts of reasons. Could be scale, could be low cost advantage, could be intellectual property, could be network economics, could be so many things out there, could be brand, could be pricing power, could be so many things over there, could be customer obsession, could be whole lot of things. And it has reinvestment opportunities, which means it can grow, it is scalable. It can grow its business, it can put the money back to work. If the business is compounding capital at 30%, why would you want it to pay you a dividend? Because you'll take the money and put it in an FD for 6%. You would want the compounding to happen internally. How can compounding happen internally? Only if there are reinvestment opportunities. Now those reinvestment opportunities, if they're typically in the same business in which the company operates, not in some unrelated diversification or something like that. What you're doing right now, you just keep doing more and more of that. That's what the classic highest quality of reinvestment opportunities would be. So you have the third component, which is reinvestment opportunities. Then you have the strong balance sheet. You don't take unnecessary leverage. You have a liquid balance sheet. You're opportunistic. You don't do stupid things on your balance. You don't have asset liability mismatch. You have low leverage and you have highly liquid balance sheet. All of those things which give you capacity to suffer and to ride out of economic storms that will inevitably come. So you have the fourth component, and then when you add the fifth component, attractive valuation, which is rare to find when you have the first four component, but it's not that rare. It does happen. It happens during some global event, or it happens during some industry-specific event. It could also happen during some company-specific event, and so on. But these things do happen when you have those five components. Then the proof of concept is already there, and the returns are protected for all sorts of reasons, and the business is growing and is likely to continue to grow for all sorts of reasons, and they have a strong balance sheet. So what that means is that they're generating enough cash and they don't need to have a lot of debt, and therefore they don't need to issue more shares. So the dilution risk is also not there, and so on and so forth. And you get an attractive valuation. When I say attractive valuation, it could be based on what I mentioned earlier, a debt capacity bargain, or earnings yield less than earnings yield more than 150% or 200% of bond yields, and so on and so forth. So there could be many ways of thinking about that. It's the simplest combination, right? So that's keeping things simple. So a lot of things that we talk about is stories, narratives. So we can talk about how a business has become better over time because of wonderful things that they have done. There's a story out there. The word story is often used in a very derogatory manner in the value investing circle. This is a story stock. Yes, there are some fake stories out there. But I would argue that underneath every success and every failure, there is a story. And then there is these causal factors which are causing that story. The story is the narrative. But in the end, you can reduce the problem to numbers. The numbers are over here. These are the numbers, the usual suspects that you're looking at. High returns on capital, reinvestment opportunities, strong balance sheet, attractive valuation, protected returns because of the presence of some sort of a competitive advantage. So those are the causal factors which are causing that story to happen. The story could manifest in different ways. It could be a national stock exchange which became a monopoly and took away all the market share from Bombay Stock Exchange. It could be some chemical company which became better at what it was doing and it became very successful. It could be a pharmaceutical company, it could be an automobile ancillary company, it could be anything. Those are all stories, but underneath all those stories are these usual suspects which we can reduce it to. So that's the simplest case. Now we can add complications later. A lot of people actually can expand the universe of opportunities by adding complication later. So it could be, for example, the earnings are not there right now, but they're camouflage. Actually, business is investing for growth, and there are some business products or services or branches or factories which are not making money right now, but overall the company is making money. If you were to do a sort of a P&L or ROIC of individual segments or individual product lines or branches or what have you, you will find that some of them make a lot of money, some of them are moderately profitable, and some of them are actually loss making. But loss making are loss making for a reason, because they are new businesses and it takes time for them to. So it's like a waterfall. So there is a very high return business and then a low return business, and then they go below the x-axis, below the horizontal axis, and they are loss making. Loss making doesn't mean bad businesses. Loss making could simply mean that they are not mature right now, so they need time to get better. The operating leverage is to play out, or the capacity utilization is not there. So you all know what causes those accounting losses, but they are not real losses in the true sense of the word. They are basically investing for growth, and as a consequence of that, the overall profits, when you divide them by the capital employed, turns out to be not that great. So it is not conforming to the simple formula I mentioned earlier. It is not already high return on capital business. Some businesses are high returns, some are poor returns, some are pathetic returns. And on the aggregate, when you combine these, you end up with what appears to be mediocre. But as they say in ice hockey, go where the puck is going, not where it is. You have to go directionally. Ye kahan ja raha hai? What is going to happen to those poor businesses? Are they going to get better? Are they going to become from cash consuming to cash generating? And if they're going to become so, by when will that happen? The interesting thing is, by the time that happens, the company keeps investing more and more, and you will continuously see what appears to be a mediocre ROIC profile, because it is continuously investing for growth. Now think about this for a moment. If they stop investing for growth, the numbers will start looking good. The ROIC will go through the roof, because the ones which are immature will become mature over time. So is this what analysts should be asking the businesses to do? That boost your ROE, boost your ROCE, because I'll give you higher multiple? They can simply do that by stopping the investing. Just stop the investing and the cash flows will go through the roof. The immature businesses, as they become mature, the margin profile will improve, the ROIC will improve, everything will start looking wonderful, right? But that's not how wealth is created. Long-term wealth is created by putting money in projects that make economic sense, even though in the short term they may look terrible projects. And even though they pull down the overall ROIC of the business, you want those businesses to continue to do that. So optically they don't look very attractive, but they are. So that's what the complication part is, that you start from a simple case and then you make it more complicated. That's how, this is the conformity to that pattern. So you're looking at a business. So don't reject a business which is selling, which is earning like 10, 11 times ROCE. Go deeper and find out, are there businesses inside, some of them earning 30% ROCE, maybe some of them are earning minus 20% ROCE, but they were earning minus 40% 3 years ago, and that number is changing. So there is directionally happening. It happens in the hotel industry, it happens in the hospital business, it happens in so many businesses which have upfront capital burden, where all the bad news is front loaded, but all the good news back, and so on. They are doing a lot of things which are going right for them. The customers are obsessed with this particular product. They're getting customer loyalty, and the markers are there. The markers will show up. They won't show up in quarter to quarter, but they'll show up over a period of time. So it may not qualify as a great business right now, but it is on its way to become great. That's again, of course, a complicated situation, because what if you're wrong? But if you're right, then you're buying it in a situation when it is not recognized as a possible great business going forward. And if you're particularly buying it at a valuation where the greatness is not implied at all in the valuation, then if the greatness occurs, you make money. If it doesn't occur, you don't lose money. That's a good combination to be in, right? That's exactly what Richard Zeckhauser's ideas about uncertainty about the future and turning it into a friend means when you also wear the hat of a value investor. It could be a turnaround situation. It could be a pretty bad company, badly managed, but there's a change in management. A new guy has come in, he has a track record and he's done something wonderful in the past, and you think he's going to repeat, he or she's going to repeat the past track record, and you can think on those lines. Or it could be genuine industry turnaround without any change in management. It could be a commodity industry which is experiencing a shortage, which is just gone from glut on its way to shortage, which is going to get worse and worse, which is the best news for the industry, by the way. So you may be investing in that kind of a situation. So again, these are complications, but those complications are very attractive from a value investor point of view, but at the same time, you don't have to do them if you don't want to do them. You can stay with the simple cases and have a fruitful outcome. Your business could be deleveraging by selling off assets which don't make any money, so nothing enters the P&L, and there is the primacy of earnings picture. So markets favor EPS growth, and they sell off an asset which was not making anything. So there is no loss of revenue, there is no loss of earnings, so to speak, but that asset is sold at a very high valuation, and the money is being used to retire debt. So instantly the debt goes down, and the interest expense goes down, the earnings per share starts going up, and markets recognize that. So basically, what you're betting basically is on change, that there is some improvement that is going to happen, which is not yet visible, at least not visible to the markets as of now, and what appears to be mediocre will become superior. So it's go where the puck is going, not where it is. So you're visualizing, really you're mentally visualizing this is what the business will look like 5, 7, 8, maybe even earlier, 3, 4, 5 years from now. This is interesting because there are all sorts of business models out there, and some business models are inherently more complex than the others. That's the way it is, right? There are easy to understand businesses and there are hard to understand businesses, and even within investors there are people who have certain capabilities of understanding certain kinds of businesses and others don't. So if you happen to be a chemical engineer, you will have a certain advantage about understanding chemical businesses and others don't, and so on. The thing is that some businesses are inherently complex and there are too many moving parts. There are too many things that must happen for you to make money. And that's basically complexity. I like to think about complexity in many ways. One of them, of course, is what I just described, that the complexity of the business itself. But I also think about the thickness of the annual report as a very good heuristic to figure out how complex this business will be. If the business annual report is 500 pages, then there is something, how much effort will I have to do to understand this? Or think about the number of subsidiaries the business has. And if there are 60 subsidiaries all over the world, then you have to do a lot of work to understand what the hell is going on. Because as an accountant, I know how easy it is for you to camouflage stuff when you have all these things going around. If you have a simple structure, one company in one country doing lots of things right, it's an easier model to have. I'm just talking about the other things remaining the same. My preference is overwhelmingly in favor of the simplicity, because I think about not just return per unit of risk, I also think about return per unit of effort, just to understand this thing. Instead of that, when you have other things which are simpler, even if you make slightly less money in those things, I actually overwhelmingly prefer that alternative. Simple cases, basically, inspired by what Buffett once said, that degree of difficulty doesn't count. He talked about Olympic diving. The more complex the dive, the more marks you get and something like that. He says it's not like Olympic diving. You would be investing in a simple businesses, an idea that comes to you, just a flash of a moment, and you invest in it, but you may have spent time doing diligence on a business for 6 months and you end up making mistake in the second one, but the first one makes you a lot of money. Buffett likes to talk about Enron footnotes. Some of the businesses are so complex and run in such a manner that they don't want you to understand. So they can make things look very, very difficult. And by the way, we now have a tool to fight this, and it's called ChatGPT. As you all know, you all have heard about this. It's a tool that I've already started using. I've become paid subscriber to a couple of services. I'll show you some of the stuff that happens here. It's a great tool to simplify, to remove jargon, there are all these prompts that explain this to me as if I was a 10-year-old boy. It will give you the explanation. It may turn out to be too simple, then you say, no, treat me as if I'm a 15-year-old boy. You can actually have a conversation with it, by the way. It's not just like one-time question. You can refine your questions. You can say, a while back I was helping a friend of mine who was negotiating an employment contract, and the employment contract to my first reading was very onerous. So I dumped the employment contract in ChatGPT and said, show me all the onerous clauses, and it came up with 6. I said, this clause is having a termination penalty, that if you leave this company within 3 years, then you have to refund to the company, to the entrepreneur, the money that he has invested till now. Even though you are the CEO, he's backing you to be sure, but you have to refund whatever money he has invested, which is like a deal breaker. Really, it was extremely onerous. I said, can you modify this? It will give you suggested modifications in legal language. So, you need to do something about this. So there are tools that are becoming available, and these are at a very nascent stage right now. So don't be skeptical about these things, turn them into your friend. And they can really help you cut down on a lot of the jargon and the complexity. So the other day, Anuj was in office and he was helping me. We dumped some complex sounding text of intellect design business model thing and dumped it into ChatGPT, and it comes out with an explanation. Ye karte hain. Remove the jargon. Tell me what are they doing. It will come up with insights that you may go around looking for people who understand that industry and explain it to you in a simpler format. But there are tools that are available now which will help you do that. Cut the jargon. Try to make things simple. So in mathematics, we have this multiplication rule. You studied that. If there is a 10% chance of some adverse development with really bad consequences, and there are 5 such independent things, what are the chances that at least one of them will happen? 41%. There are 5 things that can go wrong, and they're all independent, but there's only a 10% chance of any one of them going wrong. You're looking at a 41% chance of failure, because any one of them can pull you down. So think of what you call as a chain is only as strong as the weakest link. So think of weak links in a business model. You don't want too many weak links. You don't want too many things to go wrong. Even if you have a 90% chance on any one of them not going wrong, they will go right. You still end up with a huge probability of an overall loss if any one of them happens. These are very elementary ideas, right? We were taught them in school. And then I see Excel models and I see them all over the place. And some of them can get really, really insane. Of course, we know the behavioral side of Excel models. The goal seek function need not be there. It's already embedded in the people who are making the models. It'll give you what you want. But it gets complex. Graham said the role of analysis is the element of chance. He said the fact that you're trying to analyze a situation is independent of how chancy it is. By the very nature, if you are in certain industries, if you are in the oil exploration business, then a field that makes economic sense at $30 a barrel does not make economic sense at $10 a barrel. But what if it goes to $200 a barrel? It becomes insanely profitable, right? So how do you value that field? How do you predict whether it will be 10 or 30 or 200? We have seen 120, we also seen 6. So when the ranges of outcome are very huge, it becomes hard to convert them into a model which makes sense. You can do it, the number crunching will, the model will do what you tell it to do. You can assign scenarios. There's a 30% chance it will be 120, there's a 5% chance it will go to 200, and there's a 5% chance it will go to 6. But by and large, it will stay where it is right now. So if you do that kind of thinking, you can come up with a number, this is the value of this business. But that doesn't tell you anything about the value of the business, because actually there is no way of predicting what the value of the business is going to be. It is a speculative business, and recognize that this is not investing, this is speculation, and there is nothing wrong in speculating, but don't try to use the tools meant for investing in the field of speculation. So there's no point trying to do that kind of analysis. There are ways of dealing with speculative situations. We'll talk about that. Option framework is a very important way of doing that. Lottery ticket that I mentioned earlier was another way of thinking about it. But it's not DCF. That's not the way to do it. And it applies to so many businesses which have this kind of huge variability in their underlying economics, which is totally outside the control of the business. It's not in you are a commodity player. You're a global commodity producer of graphite electrodes, of iron ore, of steel, of natural rubber or sugar or something like that, and then you are trying to make predictions about this is how it's going to happen. It's not easy, to be honest, in my view. So how do I show you this? Okay, I'll mirror the displays. And then I'll open this thing that I got. Beerly is a very interesting application based on AI. I have Wi-Fi requested here. So one of the things you can do writing, reading, marketing, chat, images. I want to go reading, and I have subscribed to this service called Deep Summary. So I take this document and do upload. And I had this blindness to the benefits of ambiguity, the document that I mentioned to you earlier. I upload this document in this. It's done. I run it. Now it is blind. It's actually going to each section and summarizing. It's not like a blind summary of something. Or you can do that too. You can say summarize this in 10 bullet points. It will give it to you. You can say expand on this bullet point. It will give it to you. So it's extracting, and it's going to reduce a 27-page document into something like a 2-page 800 or 900 word document, and a very good summary, by the way. So this is becoming available to us at virtually zero cost. Normally you would need to go to some expert कि समझाओ ये क्या हो रहा है. It's not going to be, and by the way, technology is going to get better and better and better. It's going to become very, very quick, very, very fast, and very, very good at what it does. So neglecting the benefits of ambiguity. Try it out. I don't want to just do this. It takes each section and it gives you a good summary of what is happening in that section. And in a very simple language. So I use it almost on a daily basis now to help things, to do things. Of course, there is a darker side to it. Universities, students using it for plagiarism and not really learning. But the same argument was made about calculators. People will stop thinking because they have calculators. So when technology comes, it depends on, it's a double-edged sword. It's here. The genie is out of the bottle. It's been given to the masses. They are playing with it. And we've seen the adoption rates, the fastest of any technology in the world till now. I think they've hit 100 million users. They've started the premium service 2 days, 3 days ago. And it's been funded by people. They're going to put billions and billions. It's been integrated in Microsoft Word as we speak right now. So it's here. It's not, and you better use it. And it will get being misused to be sure. It is here. It's going to get better over time. It's going to get faster, cheaper, better. All of those things are going to happen. So why not use it for our purposes? And part of that for us is basically, I need to bring this here, to simplify things, which is what I did over here. 27-page document was reduced to 811 words. At a fast Wi-Fi, it will happen in like 10 seconds. Beerly. Beerly.ai. Most of the things are free, by the way. Okay, the other thing which is interesting is Maxim 4, which is when you're trying to understand complex real-world situations, think of an everyday analog. This is very important and very interesting to me because I've been talking about this for many years, and I've just talked about a little bit about it today. The role of analogies and metaphors. We try to make things of sense of what's happening in the world, and we have learned a lot of things as kids. We've a whole lot of things. So even Richard Zeckhauser says that analogous thinking is also analytical thinking, because you want to have an initial hypothesis. Is this what is happening? Basically, you're trying to recognize a pattern. What does it remind you of, and why does it remind you of it? So if it reminds you of an analog, use that analog. I'm going to give you multiple examples so you understand exactly what I mean. But these analogs, the metaphors are very important because they conform to what is called as the Lindy effect. They've been around for a long time. And the reason why they've been around for a long time is because they have real practical utility. They get applied in so many domains. So why not do that? So let's look at a few examples, and I think you will give me the examples, the applications. In our field, so ripples in a pond. Think what happened during COVID to certain businesses, like consumer discretionary, like movies, like restaurants, like hotels, like working from home, like doing exercise at home instead of going to a gym. Now, knowing what you know about human nature, do you really think that once this problem goes away, these businesses will continue to prosper? Some businesses really prospered because things like Zoom, for example, or Netflix, for example, or Peloton, for example, they really prospered because There was or working from home, anything that was to do with working from home. People thought that commercial real estate is gone, or people thought that restaurants तो कौन जाएगा, movie hall का कोई कुछ नहीं, no, theme park, movie hall, fun things that people like to do. But knowing what we know about human nature, we are social human beings. We don't go to a restaurant just to eat food. We go there to watch what's happening on our next table. We want to see what they're eating, we want to hear what they're saying, we want to be in an atmosphere. The very fact that you're sitting in a restaurant when there is no sound is very boring, right? You want to go to happening places, you want to mingle with people, you want to have encounters with people who might become your friends, you want to bump into people you haven't met for a long time, and so on. That part of the nature was never gone. There was a ripple, there was a rock which dropped in a pond called the world, and the rock was COVID, and there were these ripples that were created. Now we don't know how long they will last, but we know that the bigger the rock, the more the ripples, but we know in the end it will become the same again. And if you look at the numbers of some of these companies, the companies which got hammered are coming back, the companies which prospered are going back to the old ways. So the thing is, the point is, this is just an analog, right? Ripples in a pond will remind you of what's happening. If the COVID comes, you start thinking, is this permanent? Is it going to last? Is this real? And some of these businesses which are prospering or start selling at insane valuations, even though they experience not just earnings growth, but also multiple expansion. But multiple expansion is warranted only if forward earnings growth will continue to be rapid. But if it was a ripple in the pond that is playing out, and there's something wrong here, that when the pond, when the rock goes down and the waves go away, then it will go back to normal. In fact, it will be the opposite. People will start going back to gym and they don't want to use the Peloton cycles at home anymore. There will be too many Peloton cycles out there in the second-hand market being sold because it's uselessly lying in your home, which will compete with new Pelotons that companies trying to sell. Isn't that obvious to think about it in this way? So the point I'm making is that these analogs tell you a lot about our areas. The dagger in a steering wheel is a wonderful analogy used by Warren Buffett to explain the idea that if you put a dagger in the steering wheel and you're driving a car, you're going to drive very, very carefully. But you may experience some potholes or some speed bumps which you didn't see, and then the outcome is not good. So he combines this with the idea of a leverage. You know, if a leverage business model, then it's like a driving. Of course, leverage will make you more careful because you have to return the money. Yes, there is an argument in favor of using leverage to become more disciplined about capital expenditure and spending and capital allocation. Yes, that's true. The world of private equity industry has come based on that very assumption. What did they buy out debt-free companies and they put debt on the balance sheet and pull up the socks and bring some financial discipline and so on and so forth. They cut out all the unnecessary capex. Yes, but the flip side of that is that also end up with more accidents. And yes, that happens all the time, right? So a dagger in a steering wheel is a very interesting analog to use when you think about this is what they're doing is very dangerous. If it works, it works. If it doesn't, it only has to not work once and you're dead. Or the man with the hammer, we talk about that. You try to solve a problem with one toolbox and you don't have a multidisciplinary mindset. And you know, man with the hammer syndrome, people who follow Charlie Munger would have heard about it 50,000 times. Painting everything with the same brush. Give me an example of that. There is some bad apple in the industry and the whole industry gets derated because this thing is sari fraud hai, or something is wrong, something terrible happens to one company in the industry, the others are doing fine, or one of them is doing fine and the rest of the others are not, but the one which is doing fine also gets derated because of the troubles that exist in a given industry. So again, the inability to distinguish between what is superior and what is mediocre is elegantly explained by a very easy metaphor, simple example of something like a painting everything with the same brush or throwing baby out with the bath water. These are all things that we have learned as kids. We read about these things. Why are they here? They're here for a reason. They conform to the Lindy effect. They tell you how to make sense of the world. So when you're looking at a company which has been derated because of industry downturn, it may turn out that while it is actually benefiting because of the industry downturn, because it is taking market share from players who are weaker and don't have the cost advantage that you have or don't have the scale economics that you have, but the stock has still been thrown out. It's like throwing out the baby with the bathwater. So de-rating is happening. It's an opportunity. So you have to find the baby, not the bathwater. So get the baby back. Or this is, I knew Safir will be here, so I made sure that I buy this particular. So I spent some money, Safir. You owe me a coffee for this. So when you see people do some really stupid things, they tells you something, right? That this is not what I want to do, and there are so many of them out there, and I don't want to put this being recorded, but in unrecorded sessions I actually put a slide of 10 or 12 people, and one of them is always blank because उसमें next वाले बंदे का भी जगह छोड़ी होती है. We all know about this one, right? A lot of this is happening right now. So these are all things that we are familiar with. The stock's going down, should I buy it just because it's dropped? Is it like catching a falling knife, or is it actually getting cheap? What is the reference point? The reference point should be the highest price that the stock has seen, the 52-week high, the recent high, or what is the underlying value? How much is it worth? Even after a 50% drop, it will still be insanely expensive, right? And any stock that is going all the way to zero will at some point of time sell at 52-week low, then it sell at 5-year low, then it sell at 10-year low. All these things are just numbers. They just are anchors that we latch on to which don't make any sense. Picking up pennies in front of a steamroller. A lot of risk arbitrage is like that. You have small spreads. You make $6 on a 50 rupee investment in 2 months. So IRR looks very good, but if the deal collapses, that $50 could go to $30. So you're effectively picking up pennies in front of a steamroller. So factor that in your thinking when you're thinking about special situations, or what is the absolute amount of money you're going to make in return to what you could lose. People go broke. They don't think about this like this. LTCM was picking up pennies in front of steamrollers, and they did it so well for so long that they thought this was permanent. So they had small spreads between a 30-year treasury bond and a 29-year and 3-month-old treasury bond. And they are virtually identical. There were small spreads between them, but to exploit the arbitrage spread between them, they had to use leverage. So they had 95-5 leverage built on top, and you thought this is like a law of physics that the spreads can only narrow, they cannot diverge. They actually diverged, and they went broke. They were effectively picking up small amounts of pennies in front of a steamroller, and this happens a lot. And these are Nobel laureates, by the way. We're not talking about some idiots over there. Some really, really smart people and end up forgetting that there's a steamroller out here. I talked to you about go with the puck is going. Here is one which is a lot. You see that in private markets going into public markets. Companies passing the parcel at ratcheting valuation, various rounds of financing that happens in the VC world, and then the stock gets listed on the stock market, and the motivation of the markets is very different from the motivation of the private players who dumped it on the markets. So basically, whether it is a Paytm or a Zomato or so many companies which were actually cash-consuming businesses but came to market, they're realizing that the stock markets look for cash flows. They look for earnings. And this thing can't last. And in the IPO market, passing the parcel and I'll flip it. So the games are there. There are all these games that are there. They remind you of what's going on. So when you see what's happening in, at least the way I see it, I see businesses getting valued higher and higher and higher in rounds of financing in private markets. Then I think of that. For me, it's a good initial. I'm not saying that all of these situations are like that. To be sure, some of the greatest businesses in public market today were funded by private players and have created billions and billions of earnings for the others. But it's a good metaphor or analog, an analogy to use as a starting hypothesis, to ask the question, is this what is happening? And that's the important point, because you're trying to make sense of the world, and that's the role of the metaphor. Is not that you are convincing yourself कि यही हो रहा है. नहीं. You are actually, this is the starting point for you to think about that this might be happening. Is this what is happening? Is this, or is something else happening? Let me investigate and then decide. So you need an initial hypothesis, then you need new information to end up with posterior hypothesis, which is what Bayesian reasoning is about, and I'll come to that. But essentially that's what the game is about. Where do you get the initial hypothesis from? It could come from a variety of sources. It could come from base rates. So you are investing in an airline company, but the base rate of the airline companies is bad. But maybe this airline company is different, and therefore you discard the base rate, or you don't put too much attention on the base rate and you focus much more on the uniqueness of this particular business and not the base rate. But you can't ignore the base rates completely. The point is, you said, okay, I'm going in the airline industry, but the airline business sucks. I know that. The world is full of bankruptcies in the airline world, but I'm still going in. Why am I going in? So I'm not ignoring the base. So my initial hypothesis is this is a very tough industry, but I'm going in because this business is materially different from the rest of the others. It's not the same, and therefore I would do that. I'm not ignoring base rates, but I'm also not ignoring factors specific to this particular business which might make it unique and may dilute the base rate. So my posterior odds will reflect both base rates and new information about this particular business that I'm looking at. Or your initial hypothesis could come from something as simple as a metaphor. You're looking at a high margin business which has low entry barriers. It's like an open jar of honey. This is from Philip Fisher. Why would it not attract competition if the entry barriers are not there? And we've seen that in the gold lending businesses in the recent past. Some businesses have prospered enormously well in the last few years, and I think they got greedy and they had huge spreads between the yield on the loans and the cost of the loans, and they've experienced a lot of competition. Whether the competition will last or not is a question that yet to be answered. But the fact is that there was an open jar of honey. It was attracted. On the flip side, if you see a business that earns high returns on capital, but the margin is very low, the low margin business is a sort of an entry barrier. Reddington is a classic example. It earns 1% PAT margins. It's got phenomenal economies of scale, and nobody wants to enter that business. And even if they enter, nobody wants to deal with a new company entered in that business because you need to have distribution strength over many geographies, and you need to have the scale to be able to operate profitability with that 1% margin, which nobody else has. So a business that earns high returns on capital with very small margins is more robust than a business which earns very high margins, very high returns on capital with very high margins with low entry barriers. So it's too painful to confront reality, and we all do this in our own ways, in our investing lives, in our business lives, in our personal lives, to some degree. So so you have to basically ask yourself. Then there is this thing about greed, corporate greed, that you start becoming too greedy with your customers, and you start taking advantage of your customers, and basically you have a business which is doing very well, and basically you jack up the prices, and you think that they don't have choices, but they have, or the competition will come, choices will come because you are making it easier for somebody else to come and attack your castle. Why not earn less now, but for a longer period of time, and be less greedy and make more money in the long run than be more greedy? So this is the story that we all studied when we were in school, right? And we see the story playing out over and over again. Don't we see that? Canary in a coal mine is a very interesting metaphor about early warning signals. That there is this business which has gone through a terrible period, but it is in an industry where there are many other players who are also in the same situation, and this company going bust is an early warning signal for you. So canary here is the example. For those of you who don't know, in mines they used to have low oxygen. When canaries, they would take these birds inside, and the bird would die before the miner would die. So if the bird dies, that means the oxygen is running out. Run out of the mine, get out of the mine. So it's one of those things, early warning signals. Canary in a coal mine. There's some. It could be in micro lending businesses. It could be in so many situations where you would be looking at a canary in a coal mine. There are potential problems looming which are not yet been recognized, but this could be. Is this it? I don't know. But the question is, analogy, metaphor actually tells you that at least ask yourself, could this be a canary in the coal mine? Let me investigate. So it's a good way of getting an initial starting hypothesis. It could be lemming-like behavior. Interestingly, many of these metaphors that I'm using, boiling the frog and lemming-like behavior, these are myths. Frogs always jump out of the water, no matter how slowly or rapidly you boil the water, and lemmings don't jump and commit mass suicide. But these stories have been around for so long, they teach us something. So a lot of these things are mythical things, which still tells you about what bhed chal or lemming-like behavior, how people rush to the exits and people were not buying an FPO at whatever price, and today the price is 1/2 of what it was, and they don't want to buy that either, even though the money has been released back to them. That 20,000 crore example that we've all been reading about in the last 3 or 4 days. But what are the dangers of this kind of thinking? Of course, this kind of thinking is very helpful, but all methods, all tools have dangers too. So the big danger here is that the opposite of an analogy may also be true. So the early bird gets the worm. That's true. It tells you about something, that your first mover advantage, but the second mouse gets the cheese is also true in some situations. That being a late mover is actually better. Let other people spend all the money developing the industry and you just stand back and wait for the market to develop and you enter late. Many companies have prospered by having that particular strategy. So you got to see what is really happening. When you're trying to make sense of what is happening in the world, these are just tools to help you think through and cut down the complexity. So I always try to use them as an initial working hypothesis. Okay, now I have 4, 5, 6 maxims continuously. Maxim 5, the world is much more uncertain than you think. Think probabilistically about the world. 7 is uncertainties is a friend of the status quo, but it doesn't have to be. Good decisions sometimes have poor outcomes. Some decisions have a high probability of a bad outcome. Information is only valuable if it can change your decision. And number 18, eliminate regret. So they're all over the place. I picked up 5, 6, 7, 8, 9, 12 and 18 and clubbed them in one place because my discussion is in continuation and I will keep on relating these maxims to each other. So they complement each other. So let's study them. One of them, of course, I talked about earlier is the range of outcomes. The business world and the stock market world are not like a casino. In a casino, you know the odds of the game that you're playing. You know the outcomes. You know the probabilities. In the business world, you don't even know the various possibilities, let alone the probabilities. Same applies to stock markets. Anything can happen. We've seen some crazy things happen, right? We all lived through COVID. And we've seen some incredibly insane things happen in markets. So the wider the range of outcomes, the more the complexity and the more difficult it is to make predictions. I've already talked about prediction versus protection, so I'm going to jump this one. Extremely unlikely things happen all the time. But one of the interesting things when you study the theory of probability, there are lovely books by a guy called John Allen Paulos. One of them is Mathematical Illiteracy and Its Consequences. Wonderful book. And basically he says that if you study probability, you will find that some unlikely event is likely to occur, whereas it's much less likely that a particular one will. Reminds me of a funny quote, when you see a dumb guy, you think, is this a sperm that actually won? So how do you turn uncertainty into a friend? That's exactly what the original talk on 2012 was about. And I talked about risk and uncertainty. I talked about option framework, lottery tickets. That mathematically you should never buy a lottery ticket because the cost of the lottery, if you add up all the lottery collections, will turn out to be more than the payout that is made. So it is a mathematically negative expectation game. You shouldn't be buying lottery tickets. But what if they were given to you for free? If somebody bought a lottery ticket and threw it on the floor and is unused, you can pick it up, right? That's what markets give you. Markets provide you with free lottery tickets or cheap lottery tickets or undervalued lottery tickets and a lot of the time, and that's a good sort of example to have in mind. So let's talk a little bit about the upside of uncertainty. People associate uncertainty with something to run away from. It's risky, the outlook is not clear. We are all wired to fear the downsides of uncertainty, but we forget that change, creation, transformation and innovation really show up without some measure of it. This is from the book that I was mentioning to you about the upside of uncertainty. Instead of fearing and avoiding the unknown, you recognize and embrace it as the origin of possibility. The key word here is possibility. Okay? Not probability. You don't know the probability, but you know that it is possible, that there is a possibility. So is there a way in which you could protect yourself on the downside, but expose yourself to favorable possibilities on the upside? The value investing framework tries to do exactly that, isn't it? This is a long one, so you can read it. Can you all read it, or should I read it out? Can the people at the back read this? The focus is not so good. It looks much better here. Okay. Human beings are wired to fear uncertainty. Psychologists argue that fear of the unknown may be the fundamental fear underpinning all other anxieties. And neuroscientists have demonstrated that we have multiple neural alarm systems that fire in the event of uncertainty. This presents a challenge for us because despite being wired to fear the unknown, the only way we can get new possibilities is by first facing uncertainty. The good news is that if we can learn to frame uncertainty as a doorway to possibility. So I'm going to use these words, doorway to possibility and framing it. How to overcome the mental wiring that we all came with because of evolution. The good news is if we can learn to frame uncertainty as a doorway to possibility, we can actually use the same wiring in our brain that warns us against the unknown to help us get excited about and even embrace uncertainty. In fact, some people have become so skilled at that they learn to see uncertainty as a good thing. Good VCs are like that, right? They are operating in a field of crazy uncertainty, even choosing to create more of it on purpose because they realize it helps them access new possibilities. Let's delve a little bit on this. One quote that comes to mind is that of Peter. I misspelled him. It's Peter, not Perter. He actually, most people in the value investing community have been trained to think diversification is a risk reduction tool. That there are margin of safety. If you do it a lot of times, you bring down the risk. It's a risk reduction tool. Things that are risky at the individual level cease to become risky at the portfolio level because you have so many of them and they are independent. But Peter Bernstein actually considers diversification as a exposure to possibility tools. That I want diversification because it increases the possibility of my exposure to some multi-packet, which I would miss if I had a very concentrated portfolio by choice. I'm not saying that you shouldn't have concentrated portfolios. I'm only giving you the counter argument in favor of diversification, not from a risk reduction standpoint, but from an exposure seeking standpoint to possibilities, which is, I think, very insightful. So there is a wonderful example that he gives. I'm going to do that. By the way, how many of you have actually read the book on Maxims for thinking analytically? I hope not. Okay, one of them has. So I'm not going to allow you to answer the question that I have because the question is taken from the book. Imagine you're contemplating transporting 100 identical items one by one over the Niagara Falls using buckets. There are two types of buckets. The first type has been used 100 times and has succeeded 70 out of those 100 times. Whatever material you were transporting reached safely. 30 times it dissolved, it disappeared. The second time has been used 2 times and succeeded only once. What would you do? You have to choose one of the two. You can't say, no, I'm too risk averse. You have to choose one of the two. What should you do? Think before answering. What should be your strategy? This is from Richard Zeckhauser. He asked this question in class from students. And it has many, many applications in the world.
Pick the first one because in the second case, we don't actually have enough sample size.
Okay. So that same argument that you gave could actually be turned around and said that pick the second one because we don't have enough sufficient evidence of the other one. And I'm going to develop on that in a minute, but somebody else has a...
Exactly, I was going with the second option for the same reason.
Yeah, so why don't you both fight and we have popcorn? Okay, please. Acha, okay, so it depends on... Absolutely. Okay, let me answer this. What are we seeing? What is the information given to us? So what can we infer from that? One thing that we can infer from all this is that the material that is being transported is not a very valuable item, because 30%, it's not like diamonds are being transported, right? It's some low value item, right? That means you want the 70% to go to 70, 80, 90%, but to get to 70, the endeavor of getting it to 70, 80, 90% may actually end up with the situation where it may end up to be 50, 40, 30%. But that's not permanent. So according to Richard Zeckhauser, in the absence of any other information or constraint, you should use the second bucket for a few times until you have better sense of the overall success rate. Remember, we have only tried the second strategy twice, and we all have studied sampling error. The sample size is too small. 1 out of 2 is 50%, but it's not the true probability. It may be, may not be. We don't know, though there is uncertainty. We don't know. It may be 100%, it may be not 100%, it may be 90%, 95%, it may well be 30%. We don't know, but we don't know yet. And we won't know until we try. If we don't try, we will never know. If we don't try, we will be happy with 70%, and if that's you, that's fine. But what Richard Zeckhauser is challenging that notion of status quo, that why to break something that is already working. He's saying that people who are tinkerers, people who are experimenters, people who don't mind making chances, people who think of uncertainty as a possible friend and not an enemy, will try out the second strategy a few times and take their chances. Agar doob gaya to doob gaya, but they will get a better sense of what the true probability is. If it turns out to be much more than 70%, you will stick with the second strategy, otherwise you will switch back to the first strategy. The switching costs are small. The losses of the consequences of mistakes are small, and you have a sampling error. So why not get rid of the sampling error, get more information, and then decide which strategy is better. But not trying at all would be exactly the wrong thing to do for people who want to think like Richard Zeckhauser. That is what he's saying. I'm not saying that you have to agree with him. Some people are perfectly happy. I asked one of my friends who is in the logistics business, बोलता है 70% ठीक है, मेरे को नहीं करना. And he would actually bring in complications like मेरा client क्या चाहता है. But the question is basically, you have no other information or constraints. So you should use the second bucket for a few times until you have a better sense of overall success rate. With the first one, you are reasonably sure that the success rate is close to 70%, whereas with the second one, you are highly uncertain because it has only been used twice. So you should use the second bucket a number of additional times until you accumulate more evidence and either conclude that its success rate is below 70%, in which case you switch to the first bucket, or conclude that the success rate is above 70%, in which case you should continue using it. ChatGPT will not know, I don't know, artificial intelligence will be able to help here or not, but
Maybe not.
maybe ChatGPT, you should also ask what would Richard Zeckhauser think of this. So then you may get a better answer over here. But the fact is that don't think of uncertainty to be run away from. Sometimes you should run towards uncertainty instead of running away from uncertainty. Just to learn more, because the cost of learning is small and the benefits of learning could be meaningful. The benefits of whatever you learn could be meaningful.
That thought can be probably we may never have an airplane if someone would not have thought that we can fly against gravity.
I missed that. Say again.
I'm saying probably we would never have an airplane if someone won't have thought that we can actually fly against gravity.
Yeah, but that way you would have no innovation. All innovation requires you to run towards uncertainty because you don't know whether it will work or not. You don't even know whether it will be a commercial success or not. It may be a scientific success. So many things are scientifically successful but are commercially unsuccessful. Now, you won't know until you tried it. The question then becomes is, how do you bring the risk management framework on this? Because now we are moving towards how do we as business analysts and investors think about this point when we are evaluating managements. So you have one spectrum of the management which doesn't want to take any chances. They don't want to lose anything. They have hugely loss averse and risk averse. They don't want to take any, they're very happy with what they're earning right now. They don't want to get better. They're very happy. They're very contented. Okay, so we have one extreme. We have those people, to be sure. On the other extreme, we have reckless gamblers who will bet the bank on stupid schemes, or even if they're smart schemes, but they will bet the bank the consequences, and they will do it with borrowed money and so on and so forth. They will add on layers and layers of risk, so we'll call them as total reckless gamblers, and we know what's going to ultimately happen to them. We know the outcome in the long run. The more you play as a reckless gambler, the more you're likely that you're going to go bust. And somewhere in between are the well-calibrated risk takers. They are tinkerers. They are experimenters. They are not happy with the status quo. They don't mind, they actually run towards uncertainty, but they never forget risk management. So they are willing to take on projects, mini projects, prototypes, small projects, pilot projects. The language is familiar to you, whatever you use, but essentially the projects have certain characteristics. One, they have asymmetric payoffs. Now the consequences of a failed experiment are small. You may lose all the money, but you will not, the company is not going to go down. You only expose 3% of company's net worth on an experiment. You lose 3% of the net worth. Things in the worst case scenario. But in the best case scenario, there are possibilities that you will never encounter unless you did this experiment. So you do that. This could apply to in so many ways. Innovation itself is a field worth studying, but there are so many ways of thinking about it. But I'm talking about it from the point of view of management evaluation on an innovation spectrum. How do you, or the risk management spectrum, how do they approach this thing about uncertainty? Do they run away from it? Do they run totally towards it with total with no protection, or they are well calibrated somewhere in between? That's what this thing teaches us, I think. One of the things that it teaches us. The other thing that we learn is asymmetric payoffs from business models. You may have where you could lose money, but the upside is a lot if some good things happen. So you know what those good things could be. It could be a turnaround in a commodity industry going through a period of glut and extremely low profitability. It could be a highly leveraged commodity business in an industry. It could be a drug discovery business. There are some businesses which by their very nature are prone to black swan events. And then there are some which are prone to negative black swan events. So this thing basically tells you avoid the negative black swans and try to seek exposure to positive black swans on terms that are favorable. And from a value investing standpoint, that's easy to understand as to how you can create those situations. Asymmetric payoffs could also come to certain people, partnering to certain people who have certain traits, certain characteristics. They are great capital allocators, or they have access to a deal pipeline which is not available to others generally. So this is the point that Richard Zeckhauser made in the first paper that I talked about in 2012. So he talked about the idea of sidecar investing. Find such people, like Buffett is the classic example. He does deals which nobody else gets. Companies go to him and say, we want to sell to you, but nobody else. He competes with private equity players of the world, but he differentiates himself by saying, I buy to keep, I don't buy to sell. And so he's created a sort of identity where he is appreciated by certain business owners who have a succession problem. They've created wonderful businesses, but they only want to sell to him, and so on. So the point is that if you are buying into Berkshire today, you're not just buying into what they own right now. You know that this is an acquisition machine, and they have a system, and 10 years from now and 20 years from now, it will look materially different. It may have many more subsidiaries that nobody can think of, even the people who run the company can't think of. So there's this optionality out there. So you're not just buying the business, you're actually buying the business with the optionality. The optionality comes along with it. And that's where the asymmetric payoffs come from. I talked about evaluating management quality and reckless gamblers versus prudent risk takers. You may get asymmetric payoffs through valuation. I talked about growth for free. If you're buying a wonderful business at a valuation where the growth component is not there in the market price, then you're getting the growth component for nothing. Now what will happen? Look forward. Supposing the growth happens, it's uncertain, you're not sure. You're confident, shit happens, something can go wrong. But if something goes wrong and the growth that you thought would happen does not happen, it won't lose you money. But if it does happen, it could make you a lot of money because growth is not embedded in the valuation in terms of the multiple. So you will get the earnings growth and you will get the multiple re-rating. You get both of them in your favor. So also think about two things here, probabilities and consequences. So the probability of something bad may happen to a business, to two different businesses may be the same, but one of them is selling at 7 times earnings and one of them is selling at 80 times earnings. What will happen to the consequences? A lot of the bad news is already embedded in the price of a business selling at 7 times earnings, but an 80 times earnings business, if it experiences even minor turbulence in forward earnings growth rate, heavens will come down. If the growth rate becomes negative, the stock could go down 60-70%. So in terms of consequences, you find, thank you, thanks a lot. In terms of consequences, you just don't think about probability, you think of consequences. That's the beauty about asymmetric payoffs in investing in businesses with low valuations, that the consequences of something going wrong. So bad times will come to everybody, but when bad times come, the consequences of those bad times on wonderful business at a reasonable price will be far less than a wonderful business at a crazy valuation. The other thing which we learn from this framework is the idea of portfolio level risk important. Position sizes matter. So for example, you may have a business which is inherently got asymmetric payoffs, has got wild possibilities on the upside, but you could also lose money on the downside. But then how do you deal with that? If you think from a portfolio perspective, from a risk management perspective, this framework allows you to have certain positions in the business, in the portfolio, which are, for example, selling at high P multiples, which are in drug discovery businesses which don't make any money right now, which are selling at infinite P multiples, for example. So long as the overall P multiple of the portfolio is kept reasonable, it allows you the privilege of having some positions in the portfolio. Obviously, if those some positions have infinite P multiple, the weight of that position should not be so large that your overall portfolio multiple becomes insanely high too. So you can have your cake and eat it too, in that sense that the framework of value investing, including growth stock investing, allows you to still manage risk at the portfolio level while managing position sizes in certain businesses which have asymmetric payoffs. It could be penny stocks, could be turnaround companies, could be even businesses with governance issues, because you're betting that some change will happen, some favorable change will happen. You may be betting that Vodafone could get acquired and there are 2-player market is not going to be allowed. There has to be a 3-player market, and I think even Safir has talked about that in the past, in at least some of his tweets, which are more like essays if you collect them together. But that's the point, and the government has stepped in and they have said we are not going to let this become a 2-player market. So things happen, favorable things happen, and so even in those situations where there's a change in control, a change in management, or even current management acknowledging that they screwed up and they fixed those mistakes, but the market is still not factoring that in their story. This happened to, by the way, Symphony when it went from $6 to $150 over a period of time. The point I'm making, to $1,000 actually. It went to $1,000, not 150. So sometimes entrepreneurs who have made mistakes say that they made a mistake, but they will continue to make those mistakes. Mr. Biani is a case in point. He has a book which he says that I took a lot of debt, I'm not going to do it again. And subsequent to that book, he kept on taking a lot more debt. And we've seen what has happened subsequently. But then there are people who make mistakes, who say that, okay, I'm not going to do it again, and actually follow through, and actually fix those mistakes, and they actually have learned those lessons, and the market is not believing them. So that you get asymmetric payoffs from those situations too. 6th maxim is think probabilistic about the world. Again, there's a framework for that, and this framework was laid out by Ben Graham in 3rd edition of security analysis. It's a framework called special situations, which we now call a risk arbitrage, and everybody here is more or less likely to be familiar with it. And basically, it tells you about thinking about both probabilities and consequences. You're betting on the happening or the non-happening of a corporate event. There's a tender offer coming. Stock's at $80. Tender offer is at $100. They want to buy 20% of the shares. You buy the shares at $83 and try to and tender all the shares in the tender offer. So the shares that do get accepted will be converted into cash at $100. The shares that do come back will have to sell in the market. So you have to think about what will happen to the price of the shares that will come back, at what price I will sell them. So there is a favorable outcome, there is an unfavorable outcome, there are probabilities associated with that outcome, and you do the calculation and you come up with an expected return, and then you deploy capital based on whether it is attractive to you or not, based on other opportunities that are available to you at that point in time. So that framework is well known, and that basically acknowledges that the world is a probabilistic place and things happen, and you should think about them from the point of view of what will happen if what you think, what you want to happen happens, and what will happen if you want something not to happen happens. So Buffett has explained this beautifully in his essay. It comes up later, actually. It comes up later. I talked about special situation framework again, but this is what it is about, right? You are trying to effectively think about the world in a probabilistic way. So the reason why although I don't do them anymore, I like the framework a lot, and I teach it in my class, and I encourage my students to study that framework, is because it teaches you life lessons. It teaches you that there are these uncertain things that can happen. So I'll give you an example. Let's say there's a situation where you could tender your shares in a tender offer, and at a very high price compared to the price that you bought the stock at post the announcement of the tender offer. But not all your shares will get accepted. Maybe 90% of them will get accepted. 10% will not get accepted. So most of them will get accepted at a very high price. But the ones that don't get accepted, if you don't factor in at the price at which they will go, at a loss of course, but the loss is so severe that when you factor that in the equation, you find that the expected return is only 6 or 7%. It's not a deal worth doing at all. But if you only focus on the 90% acceptance ratio and how much money is to be made on the shares that get accepted without thinking about what happens to the remaining 10%, you're making a fatal mistake. You're thinking that you should be deploying capital when you shouldn't be deploying capital. It is not attractive at all. Special situation framework forces you to think about the consequences of what you don't want to happen. What are those consequences if it happens? It forces you to plug in a number. That number is subjective, no doubt. It may come from old base rates and past analysis of past tender offers and past behavior of people who tender shares and don't tender shares and so on and so forth. These are subjective probabilities, no doubt. But at least it forces you to acknowledge the world is quite a probabilistic place. And that brings us to the idea of Bayesian reasoning. Again, I've done elaborate lectures on this. I'm not going to talk a lot more on that. I have a whole big lecture, I think I gave it in October quest, when I talked about the world divisible in an equation. I made a reference to it in the beginning. So you have to have some initial views. And they may come from a variety of situations. They may come from base rates. Like I said, if you're contemplating investing in a retail company, then you have to think about what normally happens to retail companies. When you are investing in a business which is a just listed post IPO, you have to think about what happens when you buy a company, a stock just after it got listed in the IPO. What usually happens? Of course, some businesses will turn out to be multi-baggers over a period of time. But what usually happens, you need to do that analysis to find out what is the nature of the activity that I'm engaging in. What is the normal outcome? What has happened in the past? And those are good starting reference points for you. Or the base rates could come from the analogies and the metaphors that I talked to you about. So you need to have some way of figuring out what the initial hypothesis, what the original hypothesis is. But we all know we end up having hypotheses and we have convictions and we buy things, but then we have to deal with new things happening subsequently. We're not traders. We don't buy today and sell tomorrow. We buy and we hold them for months, quarters, years. So we have to think about what to do when there are new developments, when there's new information coming in. So we have to have initial views. We have to have a framework to incorporate new information which could alter those initial views, either dilute them or to strengthen them We need to know what to do when those views are changed either way, and then we will end up with a new view, which is the posterior view. This posterior view will become the initial view for the next time we get more information. We also have to think about what kinds of information is worthy of being weighed, which will change our mind, and what is not. And I'll come to that in a minute because that is covered in another different maxim. So it's all about changing your minds. How to overcome commitment bias, for example, how to overcome sunk cost fallacy, how to average up because the story is getting better but the stock has not kept pace, and therefore it warrants a higher weightage in your portfolio, and so on and so forth. The process allows even quick change of mind. In the book that I reference in the talk that I gave, there is this probabilistic thinking about what happens when the Twin Towers were attacked on 9/11. The first plane goes in, what is the probability that it's a terrorist attack? Very small. So that is the initial view based on what has happened in the past. But then the second plane goes in the tower, and when you factor that in the calculation, the probability that these are terrorist attacks goes to 99.9%, very, very quickly. You may have a belief that this software company is very well run, it's very cheap compared to the main company, and then the founder of the company writes a confession and releases it to the stock exchanges that I have been stealing from this company and I have been manipulating the stock. I'm talking about Satyam. That should immediately change your view about whatever your prior views were. The point is, we know as investors that sometimes our views need to be changed quickly in light of new information that is totally opposed, and firstly it is credible, it completely destroys our hypothesis, and if you don't act now you're going to lose money. And sometimes the change is slow. Sometimes the change, so there are fundamental changes happening in the business which are slow deterioration of the fundamentals, slow improvement of the fundamentals, which are beneath the radar, like the boiling frog syndrome, that people will not notice it. Be aware of what those new developments are. So you can change your views, and the changing of the views could result in either abandoning the investment, or maybe reducing the size of their investment, or maybe increasing the size of the investment. You can do one or three things: sell it, buy more, reduce it. But which is the right thing to do based on that, and again, you don't have to get into the math of it. That's the important thing, that insight that comes from Bayesian reasoning. Once you do some examples, you will realize that these are subjective probabilities, and therefore you should try to be directionally right. If the story is getting better and the market is not kept pace, then logically it should have a higher weightage in the portfolio if the initial weight was too small. If the story is getting worse, then you should maybe eliminate the stock completely because there are other opportunities that are better, or maybe you should reduce the size of the position. So what Bayesian reasoning does is it forces you to acknowledge that things happen after you buy things, and there will be surprises. There will be positive surprises and there will be negative surprises, and therefore don't firstly acknowledge that these things will happen and then know what to do when they happen. Uncertainty is the friend of the status quo, but doesn't have to be. So one of the things that happens when there's some shit happens, there's a demonetization, or there is a pandemic, or there's a market shutdown, or there is an election, or there's an assassination, or there's a war announcement, or something of that, markets go down circuit, or they shut down, or they're totally hammered, and people are pulling money out, and there is fear and uncertainty. And when you ask the so-called experts about what to do, they say, "Abhi outlook." This is the usual answer, right? So the reason why this is happening is because these guys are also responding to fear. Fear response is processed in the innermost part of the brain, the reptilian part of the brain called amygdala. Basically, run for exit. That's what we are programmed to do. That's what evolution has told us to do. System 2 shuts down. We can't think anymore. We just run, or we are frozen like the deer in the headlights. So don't do anything, just sit there. But here is the thing, this is what the Upside of Uncertainty book tells you. For better or worse, human beings are wired for fear, uncertainty. Psychologists argue that a fear of the unknown may be the fundamental fear underpinning all other anxieties, and the neuroscientists have demonstrated that we have multiple neural alarm systems that fire in the event of uncertainty. I mentioned this earlier, it comes up again. We are all wired to fear the downside of uncertainty, but we forget that change, creation and transformation. So here is the thing that I want to tell you about. Despite being wired to fear the unknown, the only way to get new possibilities, it's a doorway to possibilities. So I'm talking about, say what happens when you are invested, you're fully invested, you don't have cash, and there's a stock market crash, and everything is down, all your stocks are down. Some are down less, some are down more. Something that you don't own is also down. And the reason why you don't own it is because they were too expensive. They were fantastic businesses, they were long-term compounders, they were just not in your buy range. But now they are. But you don't have the money because you're fully invested. What is the right thing to do? Of course, the right thing to do was have the money, but you don't have it. So what is the right thing to do? You can't, so this is a situation when most people would say, kuch nahi kar. But they forget that there's an opportunity here. There's an opportunity to improve the quality of the portfolio. So I like to, this is something which one of my teachers taught me. He said, think swap ratios. That dono share gir gaye hain. Earlier the swap ratio was unfavorable, that you could buy this or you could buy that. But now the swap ratio has become much more favorable, or something that you wanted to own has become available to you. The liquidity is in the portfolio. Find the money. Sell something which is inferior in quality or in some dimension, or the most expensive stock in the portfolio, or the least attractive business in the portfolio, or sell some of it, or sell across the board. Find the money to buy something that has become so compelling, something that you liked everything about, but you couldn't buy or you wouldn't buy simply because it was not available to you. Today it is, and it is a long-term compounder. So a long-term compounder that will give you 20% per annum is far better than a 30% CAGR over the next 6 months or next 2 or 3 years also. Because then you take care of the reinvestment risk. Because that money is invested for a long, long time. It will keep compounding. So basically this framework again forces you to acknowledge that, look, these things happen. And when they happen, you have options. So think switching, not selling. When you start saying selling, then you are thinking, oh, yeah, yes, it will happen. But the other thing is down 60%, this is down 30%. If you had not bought this and bought the other one, then you didn't buy the other one because it was too expensive. Now it has become much cheaper. It's qualitatively better and it's cheaper than what you have. The PE multiple then of what you bought was, say, 15, and what you did not buy was 25, but the PE multiple of what you bought has come down to 10, but what you did not buy is come down to 12, and it is insanely cheap. It's the lowest it has ever seen in the last 10 years. It's a great business. You won't get a chance like this. In fact, if you look at all the great compounders, you will find almost always the best time to buy them was when there's some macro event which brought down the PE multiple to a level. There are only once in a time you get these things, in one or two times in a decade kind of opportunities that you get these chances. But when they come, you're frozen. You're like the deer frozen in the headlights. Because you say, I'm already sitting on so many losses. I don't have the money. You have the money. And I don't want to take the losses. It doesn't matter. These losses will become meaningless in the long run when you make the switch. You are marrying up in a sense. I'm not saying dump your spouse and find a better one. I'm happy that she's not here today. I was thinking of calling her. Maxim 8. Good decisions sometimes have poor outcomes. It's mathematically true, right? You can read this. If you were asked what was the best decision you made in the past year, what would you say? Many people confuse the quality of the decision, how good it was, than to the process. So we all know, we know the framework about the process and outcome, but how do we actually really think deeply about what it implies? Or this Richard Zeckhauser tells you, think deeply about what this actually implies. So you may end up with a good outcome or a bad outcome, and you may have a process that was sound and process that was not sound. You can get all four. There are four possibilities here. Good, bad, good, bad. If you had a good quality process and you had a good outcome, it was like a deserved success. If you have a good quality process but you have a bad outcome, you are unlucky. If you have a good outcome but the process was lousy, you were basically lucky. And if you had a bad outcome and a bad process, it is you're getting what you deserve. Now, if we cannot judge the quality of the decision by the quality of the outcome, how should we judge it? The key is to understand what information you had or could have had at that time. You made the decision and then determine whether, given this information, you chose the path would maximize the expected value of your decision. Basically, was it a right choice to make? A lot of times, subsequent information makes us feel regret. And I'm going to come to regret in a minute, but that's not the right way to think about decisions. You need to have a good process, no doubt about it. And good process in the long run, on average, should give you good outcomes. But once in a while, you will have bad outcomes, even out of good processes. And once in a while, you will have good outcomes, even out of bad processes. That's inevitable. You can't stop it. In fact, I did a tweet sort of thing on it a few weeks ago. So you can read this. So when you have a bad outcome, it could happen because of one or two things. Either it was a bad process, which means there is some lesson to be learned here, or it was a bad luck. The process was not bad, but it just happened. Investing is a probabilistic game. Even the best investors in the world, they go wrong in so many occasions, right? So you may be right 7 out of 10. In a fabulous process, you get 7 out of 10 right. 3 out of 10 will turn wrong. And you are talking about the one which went wrong. And you start blaming yourself for it. That's what this is about, that don't blame yourself. And there's no need to tweak the process, because it is recognizing that investing in the probabilistic games also requires you simultaneously to not tweak a solid investment process simply because you ended up with a bad outcome. Because when you have a bad outcome, you feel horrible, you feel bad, you say, galti ho gaya, isko theek karna hai, isko theek kaise karna hai? Because there are other errors that you will make which will replace the errors that you thought that you had made. And I'm coming to that in a minute. As you read through the thread, you will understand where I'm coming from. So you have a bad outcome, you think, oh my God, I screwed up, I need to fix this. And you try to fix it. This is not how traders think, by the way. Traders are also operating in a probabilistic situation. They just move on. They take their losses and move on. They know that you win some and you lose some. And they're not emotionally attached as much as we guys are to the position that we end up owning. Tweaking an investment process to avoid all losses will prove to be a mistake, because one would become over-conservative. One would in fact replace one mistake with another one. I will give you an example. And by mistake, I don't mean mistake of omission. It could also be mistakes I don't mean mistakes of commission. It could also mean mistakes of omission. So let's say you invest in a tiny sum of money a small sum of money in a tiny B2C company. It's in a consumer discretionary business. At this time, it has high customer concentration risk, but you believe the business is doing good, the product is unique, and they're going to succeed. For all sorts of reasons, you own the stock. Then COVID comes, and consumer discretionary goes out of the window, spend. You bought what you thought was a great business, has got good balance sheet, has selling at a cheap valuation, whatever. There are many reasons why you bought it. But it happens to be in a consumer discretionary space. So you have a bad outcome. And the business disappears, basically, because 2 years of COVID can wipe out a small consumer discretionary business with no revenues. They shut down, or they have losses. They go from profits to losses. It happens. Business is risky. It happens, right? But remember, you had a small position. It was not a position that will take down your portfolio completely. It's a small position in a business which is risky, has got good potential, and then COVID comes. So now you have a bad outcome. So this bad outcome doesn't mean you should tweak the process in the sense that you should say, I should not invest in consumer discretionary businesses because this happened to me. Now, what are the consequences of that happening? How often do COVIDs happen? Or something similar like that happen? If it doesn't happen for the next 30 years, you will have huge errors of omission, of not investing in wonderful consumer discretionary businesses which are only catering towards aspirational consumers or luxury goods or what have you, which may not have worked out very well when people were more worried about living for the next few months than about spending money on something luxurious or something that they could do without. So this is what I was mentioning here. Such a tweak in the process will carry large opportunity losses, because then you will be limiting yourself to investing only in businesses that sell necessities whose demand does not shrink. Yes, there are those businesses. Yes, there are businesses which are like roti kapda makan, basic needs, human needs. Yeah, there is the argument that you should be favorable towards such businesses. Yes, that's true, because they are so-called recession proof and so on and so forth. But the problem is they also, everybody knows that they are recession proof, and therefore they may be good businesses, but they may not be good investments, because they are just not that cheap enough to own. They already recognize, and therefore you will end up buying those and not buy consumer discretionary business, because you just experienced a terrible outcome in one consumer discretionary business that you invested in which had a loss. But that is the nature of the game that you are playing, that there will be some. So you have to be very, very careful when you have these checklists. You build checklists on business quality, management quality, valuation discipline, that there are things that you won't do. So for example, I don't do startups, fine. I don't do IPOs, fine. I don't do weak balance sheets, fine. I don't do commodity businesses, fine. But within the things that you do, once you have decided that, you have defined your area of operation, you have defined your circle of competence, and in that circle, you know that it's not going to be 100% sixers on every ball. You're not going to do that. You're going to get out some of the time. And when you get out some of the time, does that mean you should change your style of batting? No, every sportsman knows that you will encounter bad luck. You will encounter, even if it is a small mistake, you should not try to correct it, because trying to correct one mistake could replace it with another mistake, a more serious mistake. So if you move from investing judiciously in consumer discretionary business into never looking at consumer discretionary businesses, because a cat who sat on a hot stove once never went near a stove, whether it was hot or cold, then you may be making a fundamental mistake which will reduce the possible areas of your operation going forward. And this applies. Anybody who is in the insurance business knows that when you are insuring, in many cases, if you may be a fabulous insurance underwriter at the aggregate level, it shows up in the underwriting ratio, but there will be some bad apples. There will be governance issues. There will be frauds. You can't eliminate all fraud. You can't eliminate all underwriting losses. You cannot lend money and have no NPAs. If you aspire to be a bank with zero NPAs, then you are leaving a lot of money on the table. So you have to have some degree of acceptable losses, because you have to ensure that, and supposing you have a loss in a banking system, if you're a risk manager in a bank and you encounter that there's some, are these losses acceptable or not? That's the game. That's what you have to figure out. Are they just probabilistic outcome of the game that I'm playing? On average, by investing in this industry, I make so much money, but once in a while there will be some bad apples. Do I want these bad apples to go away completely? Then I have to give up the rest of the money also. Then I will stop lending to this particular space. So you have to make that calibrated approach. Just like in a business sense, you have to do that. You have to do that in the investing sense as well. Accepting errors is a natural requirement of acknowledging that you are living in a probabilistic world. So be more compassionate with yourself when you have a bad outcome. Now, an outcome is that bad decisions sometimes have good outcomes. You just got lucky. So this happens often. For example, you bought a stock with certain trajectory that you had in mind, growth, but you thought that this 15 PE stock can go to 25, 30. It goes to 30, it goes to 40, 50, 60. You have an insane outcome. We know that these things happen. Now, Kati Patang situation is happening, and you just happen to be invested. You didn't sell it, or you sold some of it, and that sort of kept on going up and up and up. But you know that this part was never there. It's just luck. And to count on that luck to continue for you would be a stupid mistake. So you have to acknowledge that some of the outcomes, the good outcomes that you have, are happening not because you overstayed in a situation, which is not prudent to stay in, but it kept on going up and up and up. And you may argue against it, because a Philip Fisher investor would say it doesn't matter what the valuation is, if the business is has got a long enough trajectory, then just ignore the stock price. Sure, you can argue it that way also. But all I'm trying to do here is to give you an example of a situation where you may have a good outcome because of a bad process. You just got lucky. You maybe ignored certain aspects which were clearly there but did not manifest. Maybe there was a huge customer concentration risk which did not manifest until after you sold it. The day you sold it, two months later, that huge customer concentration risk manifested and the company ended up with losing a large customer. Information that you should have thought about when you invested in the first place, you didn't. You didn't factor it enough or you ignored it completely and just got lucky. So don't think that, oh, I'm so smart. You're not. You made a mistake, but you didn't get bad marks for it, for that problem. The world doesn't work like that, of course. Outcomes are what matters. And you get evaluated, people are only focused on outcomes, not on the process. And that's a tragedy, to be honest, but it is what it is. That doesn't mean that you should change your own style of investing. Last one is, I think Maxim 18 that comes up is the word eliminating regret. Now this is coming from the past one, the last two things that I mentioned. Good decisions sometimes result in bad outcomes. An important implication of this maxim is that decision makers should not regret sound decisions that led to poor outcomes. This is so fundamental. Forgive yourself, be more compassionate. You will have bad outcomes. If the process was good, so be it. It is what it is. 6 out of 10 will work, 4 out of 10 will not work, or 7 out of 10 will work and 3 out of 10 will not work, or 8 or 9, whatever the number is. All the things will work will never happen because the best investors in the world don't have that track record. If they do, they're frauds because of the sheer consistency point that I made earlier. So you should not have regret. The corollary of this is to avoid regret when a good decision leads to a bad outcome is that you should not take pride in poorly made decisions that worked out well. Moreover, even if bad decision leads to a bad outcome, wallowing in regret is not productive. So what is the way to do? So it happens the way it happens. It has happened to me more than once, many occasions. So you have a bad outcome and the process was bad. You know that you made a mistake. Knowing what you could have known based on information that was known at that time, you made a poor judgment and now you're paying the consequences for that. And you have a loss. So you have to frame that loss, I think, as a tuition fees. And then forgive yourself and move on, because there's no point wallowing in regret because that doesn't do any good. The lesson has already been learned. Regret is a wasteful emotion regardless of whether the bad outcome is the result of a good or a bad decision. Realizing you made a mistake and taking action to correct it is good, but dwelling on the mistakes endlessly does no good at all. So that's a big lesson that Richard Zeckhauser says. Frame losses into lessons, fix your processes, but don't fix all processes every time you end up with a bad outcome, because some processes are good enough and they don't need fixing. They don't need tweaking. Now some decisions have a high probability of a bad outcome. You can read this. So you have been invited by a friend to invest $1,000 who's in a friend's startup. He's a very talented guy. And he's giving the shares to his own family at the same price, so you're getting in at the bottom. You recognize it has a good chance to go broke, say 90%. But if it succeeds, it could become worth $50,000. So the payoffs are good. The expected value is good. But at the end of the day, there's a 90% chance that you will lose all your money. Now, what are the situations? Of course, value investing incorporates these ideas. You can invest in businesses where the downside is very high, but the upside is so good that it offsets the downside. Of course, you manage it with position sizing at the portfolio level. Saying no to situations where you could lose all your money. Actually, if you buy options or if you buy warrants, you could lose all your money, right? Downside is 100%, but the upside could be insanely high. Even in normal equity investing, there are asymmetric payoffs. The max, if you have unlevered, you could lose all your money if it goes to zero. But what the max that you could make is much more. So equities inherently, by their very nature, have asymmetric payoffs. But certain kinds of equities have even more asymmetric payoffs. So for example, I mean, where the downside risk is quite significant. And you may decide that I don't want to do this, which is fine. Or you may decide that I want to do this because of the following reasons. One, that the upside of the good possibilities happening is insanely good. So even if the probability of that happening is small, but the outcome is so good that I'll do it. But most of the time that outcome will not happen and I'm going to end up with a loss. Therefore, I will put only 1% of my assets into this. or 2% of my assets into this. So don't ignore the overall risk management framework, but actively seek opportunities that have very large asymmetric payoffs, and these occur in bad quality businesses, bad governance businesses. So there is a fund in UK which only invests in fraudulent companies or companies with governance issues. They have a fabulous track record. They say because it's tainted. Nobody wants to invest in those companies anymore. The auditors are resigning, the independent directors are resigning, there are fraud allegations, and the stock has got hammered, is down 95% from the peak. But there could be a change. There could be a change in management. Maybe there are assets in place which are worth a lot more than the aggregate market value of the securities that are out there. Maybe you could be an influencer in that change. So, yes, you want to, and that fund would put like 2%, 3% of their money in a single situation like that. And they'll have 25, 30 such positions. So you could also have very high PE multiple stocks where you have conviction that the high PE multiple stocks are actually justified and the earnings growth is going to be insane. Sure, do that. You recognize that the downside is quite significant. So basically the point here is that the framework that Zeckhauser is telling you allows even value investors to invest in situations where the downside risk is significant, but you still do it because it makes economic sense. It makes economic sense because the upside, even though it's a low probability upside, is so good that in an expected value table, it makes economic sense. And then you add another point, which is on risk management, that because that upside potential is so remote a possibility that most of the time it won't happen, and most of the time you're going to end up with a loss. Therefore, you should not put too much money in it. It's like a VC model. So the same special situation framework applies. So you may have a special situation framework where the structure of the table, the expected value table, is such that it may come from a high probability of success and a reasonable return, or a low probability of a success and even a higher return. Which is better? It depends on your perspective and also depends on how you manage overall risk. In fact, one wonderful thing that I want to leave you is a quote from Joel Greenblatt. So I talked to you about position sizing. You could invest in HDFC warrants when they were out of the money. A friend of mine did that, and HDFC is going to merge into HDFC bank, and the exercise price was out, and you had to pay a premium to buy those warrants. And therefore, if at the time of the exercise, which is some 12, 13, 15 months, 18 months down the road, whatever, the stock price of HDFC turned out to be below the exercise price, the warrant will go to zero. That means there's a chance that you will lose all your money. But if the HDFC bank merger with HDFC happens and there is synergies and there is just prior to the exercise of the warrants or the maturity of the warrants, the HDFC bank price shoots up, which will lift the price of HDFC also because it's locked in a swap ratio, then the warrants will go deep into the money. So he's thinking on those dimensions that, okay, I may lose 100% of my money, but I could make 3x or 4x if things work out right. There's a possibility that I could make 4x if this happens, and I think it's likely to happen. I'm favoring, he doesn't know the numbers, but he favors that it should happen. But if it happens, I'm going to make so much. But if it doesn't happen, could be 30% chance, 40% chance it doesn't happen, I will lose 100% of my money in this commitment. Which means that I should not put more than 3-4% of my wealth in this one position. By all means, you will find situations where the risk of loss is high and the probability of loss is also high, and the risk of profit is small, but the amount of profit, if it happens, is so high that it makes economic sense to do it, but not without thinking about position sizing deeply. So this is one which I like a lot. My largest positions aren't the ones I think I'm going to make the most money from. My largest positions are the ones where I don't think I'm going to lose money. Now, what does this mean? Typically, if you recall, when I talked about diversification, most value investors think of diversification as a risk reduction tool. And I shared an insight from somebody, Peter Bernstein, that look, it is also an exposure seeking strategy. It is also a strategy of creating possibilities in your portfolio that you would miss if you didn't have diversification in your portfolio. That was one very counterintuitive insight. The other counterintuitive insight that I want to leave you with is that typically when you think of position sizing, you think of conviction. How much is that, how attractive it is. But the fact is that it may be attractive, but if you truncated the downside, if the downside is not there and the upside is not insane but reasonably good, then you should put a lot of money behind it. That's what Joel Greenblatt is saying over here. Whether you agree with him or not is a different point. I'll leave that to you, but it's an interesting insight that he makes, that when you think about position sizing, you don't just think about the conviction that you have in the opportunity, but also the structure of that opportunity, that there is no way it could go to zero. Some businesses inherently can go to zero. Banking, for example, or some businesses which are like in drug discovery or in or inherently startup ventures, but structurally they are such, they are riskier businesses and their equity can go to zero. We've seen so many banks, the equity is gone to zero. The banks are around, but the original equity owners have been diluted and they've basically gone to zero, right? And then there are other businesses which are not so structurally constructed that they could go to zero, because they sell something that is a basic human need, they are unlevered, they have low customer concentration risk, they have a dominant market position, and yes, they may be not very attractively priced for exactly the same characteristics, but at least you know that they can't go to zero. But once in a while, when they become attractively priced, you should put more money behind these ones than in the ones, according to Joel Greenblatt, which could potentially go to zero. Same logic that I talked about with warrants. Now this happens, if you read this happens when you're in a soup. It happened to me multiple times. I talked about this in Money Life in 2016 and 17, I think. The consequences of risk-seeking behavior. So I used to do derivatives, I used to have loan against shares, and every time I got screwed. 3 or 4 times it happened and lost a lot of money. So I said, but the fact is that you will once in a while end up in a soup. When I say in a soup, it could mean that you have a leveraged portfolio in a market crash. Yeah, the mistake has already happened. Now the soup part is happening, right? Now you're paying the consequences. Or you bought into IPO or other promotional stuff with borrowed money. It's happened. Or you need the money, but you don't have cash. Some personal emergency or some important personal commitment, and you need the money, but you're fully invested in the stock market and a severe bear market has arrived. You didn't think it will come, but it has arrived on your doorstep. Of course, not having cash or borrowing money to buy stocks or all these things were wrong in the first place, but now you are in the soup. So no matter what you do, you will have bad outcomes. What he's trying to tell you is that sometimes all outcomes are bad. You have to pick the one with the least worst outcome. So you have to, as they say, when you find yourself in a hole, the first thing you have to do is stop digging. So you have to generate liquidity to pay the bankers, or he'll anyways sell out your stock, or you need to generate the money to pay your daughter's tuition fees, for which you don't have the money right now, so you have to better generate it in advance. If you haven't done it, too bad, the market doesn't care, and you have a loss. You have to still generate it. You have to send your daughter for education. So the point is that you have to recognize that you have to be totally dispassionate about this thing, that yeah, sure, if I sell it, I'm going to have a loss, and I don't want to, it has happened, just move on, just forgive yourself, made the mistake, don't make that mistake again, act on this thing, don't just be frozen in headlights that it will be a stupid outcome, lucky outcome of a really bad process. Don't ruin a process, fix the process. This one is very important. I think this is the last, one of the last ones. Information is only valuable if you can change your decision. I'll read a story. So in this case, Zeckhauser tells you a story. He's fond of illustrating the maximum of information gathering in an experience his mother had at a hospital many years ago. His mother was visiting Richard and Sally from out of town. At 3 o'clock in the morning, she woke Richard up saying, "You have to take me to the hospital, I am an intern." At the hospital, doctor said, "I think your mother has a bladder infection. I will put her on an antibiotic. She should feel better." 2 days later, the doctor called back. "Your mother's specimen did not prove positive. It implies no urinary tract infection. Bring her in immediately." They met the surgeon at the hospital who examined Richard's mother and ordered some tests. At around 5 p.m., after the results came back, the surgeon said, I believe your mother has appendicitis or a tumor, one of the two. However, her white blood cell count is lower than what we typically see for an appendicitis, and palpating her abdomen, it does not feel like a tumor. I would like to keep her here until tomorrow so we can monitor her symptoms. We will know a lot more. Richard responded, I presume that in either case you will operate. Is that correct? Yes, said the doctor. Then shouldn't you operate and bring in both sets of tools? The surgeon proceeded to operate that evening. It turned out that Richard's mother had a leaky appendix and a peritonitis infection in the abdomen. Waiting another day would have been dangerous. The doctor, a man in his 50s and a faculty member at Harvard Medical School, observed that no one had ever taught him, don't wait for information if it won't change your decision. That was one point. Now, how do we use, basically, it's important to recognize that information is only valuable if we change a decision. So the key word here is surprise. See, things happen. And most of the time, the news should not be surprising. So when you go back to this framework, that you have some prior beliefs, and there is new information. It could be quarterly result, it could be important corporate announcement, it could be a merger, it could be some regulatory announcement, could be anything. Now there is something that has happened, good or bad, it could be either, but that should make you move your conviction either way. It becomes stronger, it becomes weaker, it gets completely destroyed. Any of those things can happen. That's the part of the detachment to the process that you bring to the table, and that leads you to posterior probability. So the question then is that what sorts of information are relevant? Some pieces of information are more important than others. The key word is surprise. If you have a belief that this is a great business, and then the quarterly results come out and they do very well, and they gain more customers and they gain market share and the margins are intact and the balance sheet is solid and the guidance is good, it is not surprising. It is what it is. It is exactly what you would expect. So this information should not be allowed to make you believe that this is better than what it was, because it isn't. This is exactly what you expected. Only if that information makes you want to believe that they are actually doing way better than what I thought, or the information is such that dilutes completely or significantly your original hypothesis, is what should make you change your mind. So the point is that we are supposed to track all these information. We are tracking our portfolio. We have all these feeds that keep on coming in. Yeah, do that for sure, but recognize that for the most of the time, it will be like a normal distribution. Most of the time there is noise. The signals are only on the tail ends. That it will either make it better or make it worse. That's what you're looking for. If it is not surprising, it has low signal value in the sense that its value is low. How important is to identify the source of high quality signals? So this is what it looks like. There is this stuff that might actually be useful is right there, a small little dot. And then there is information and there is noise. So there is all sorts of stuff that you read on social media. Most of it is noise. It will inundate you. And then there is this framework that Ben Graham wrote about, which actually depicted in his book, which I love. This is a wonderful framework. If you look at the extreme right, is how the market prices are determined. They come from bids and offer, and those come from attitudes of the public towards the issue, and they come from a whole lot of things. There are all these things that contribute towards the attitude of the public towards the issue. They could be technical, they could be market factors, future value factors, or intrinsic value factors, right? And market factors are of three types: technical, manipulative, and psychological. Future value factors are management and reputation, competitive conditions and prospects, possible and probable changes in volume, prices, and cost. Intrinsic value factors are earnings, dividend, assets, capital structure, terms of the issue, and some other items. Now notice how beautiful this diagram has been constructed. Look at the brackets, for example. Notice that he divides the market into speculative factors and investment factors. And he, as an investor, was primarily focusing on investment factors. And look at the brackets of the investment factors. Part of it is overlapping with speculative. So he counts future value factors in that competitive condition and prospects and possible changes in prospects and volume as part of investment. Okay. Management and reputation is not something he could quantify. So it goes straight into speculative. Future value factors, this part of the bracket includes competitive, possible, and all of these things. All of the intrinsic value factors. Anyway, that's not the point I'm making here. The point I'm making here is that one man's noise is another man's signal. There are business analysts and there are market analysts. There are all sorts of things that are relevant from the point of view of what is happening to the market price, but they are not business factors. Things like FII inflows, or what's happening in equity funds inflows, or what's happening in indices. Yeah.
What if you mentioned that? What if it's not a surprise for you? It should not. The information is not important or valuable. What if it is not a surprise to you, but it is a surprise to the market?
Yeah.
Or the rest of the community?
It's a good point. So my answer to that is, as a pure fundamental investor who thinks of owning these businesses, market valuations are of importance to you, but only over a very long period of time. What happens to the market prices of your stocks over a short period of time is very much similar to what Sridhar writes about in his blogs, Buggy Human, that you are a business analyst, not a market analyst. Yes, it's true that there are all these things that can affect and influence market prices, but because you have chosen by choice, I'm not saying right or wrong, to be a business analyst and not a market analyst, you don't allow factors which are speculative and nothing to do with, which may affect the market prices to be sure, but they don't affect value. Your inherent focus is totally on, if this was not a listed company, it was a business, what are the prospects, how is the business doing, all the business factors that you talk about, earnings and assets and capital structure in terms of the issue, future prospects, competitive positioning, and 50 other things. You only focus on that and that alone, and if you have the ability to deploy capital which cannot be pulled from under your rug, which is of course the important criteria here, especially for those who are managing other people's money, then you don't have to think about those things. Then for you, a lot of those things become noise. So you can completely ignore those things. You don't have to. You don't care whether your stock is in the Nifty or not, or what will happen when it gets into the Nifty, or what will happen when it's knocked out of the Nifty, or what will happen to mutual fund inflows, or what will happen to FI. Those are they are noise for the pure fundamental analyst, business analyst, and investor, but they are signal for somebody who would do both. For example, I think Safi does both market analysis and business analysis. So he would monitor. So there is nothing wrong. The only point I'm making is, if you choose to be a business analyst and business analyst alone, then there are then your skill required are much less. You don't need to do a lot of things.
I'm not talking about things other than business. So I'm saying something, an information which is more related to business fundamentals is something which is not a surprise to you, but is a surprise to the market.
I'm coming to that.
And I'm not saying that
I'm coming to that.
Change my perception on the business, but it can change my perception on the sizing, because now something which I gave a high.
Not true. Not true. Sometimes the markets know more than you. And a sudden drop in the stock price could be an indication of some shit happening in the company which you are not aware of. So it's an event. It has happened. So it should force you to question, is my original hypothesis right? For example, so I show this in class, if you look at credit downgrades of credit rating companies, they almost always follow much later than the stock market downgrades. In fact, you can plot it. Stock is down, only in the last 3 or 4 years have credit analysts actually started talking about what is happening in the stock market. In fact, the reports also started mentioning it, that a drop in the stock price is of concern. We are asking the company about developments and all that. But earlier, it was never the case. Credit analysts were doing their own credit things. They were access to their own models and their own way of doing things. But stock markets being more efficient, some shit is happening, some fraud is going on. They got to know, some insiders are selling, or somebody who is in the know is selling, and the stock collapses. And you find the credit downgrades happen much, much later. The impairment has already happened. So to say that if the market is, you should completely ignore the stock market is also wrong, but to actively monitor things that may have an impact on daily stock market prices but have no relevance to underlying fundamentals is wrong for some people and not wrong for the others. I'm just trying to highlight what is signal. I'm just trying to highlight that one man's signal is another man's noise. And for a purist, maybe Sridhar, who absolutely refuses to look at things which have got nothing to do with the business and he thinks as a permanent owner of these businesses, a lot of this that we are talking about is basically noise. He only wants to focus. But there's another angle to this which I want to highlight. It's not about news. It's not about what gets reported. Most of the signal is actually insights that you get through your own analysis and your own thinking and your own understanding of the business model which are not yet reported. For example, an emerging moat or a management getting better in capital allocation or worse, track record, or the impending sale, possible sale of an asset which could massively reduce the debt of the business without impairing the overall earnings of the company, which has been going on for a while, but it's not happened in the last 1 or 2 years or something of that sort. The point is those insights, they will get reported once it happens and the stock will go up. But the point I'm making is you have to make your own news. The news is not going to be handed to you in a platter. You have to effectively, the most important things that you have to think about are things that are not yet reported, because if they were reported, then if the markets are even mildly sort of efficient, you would expect that the price would reflect that information, right? So the idea here is to, when you say ahead, I'm ahead of the crowd, that means I've got certain insights which are predictions about things that will happen, have not yet been reported, and therefore most people have not even thought about it, and therefore they are not yet in the price. And that's the edge that you have. It's not an informational edge, that's something that has already happened, is privy to only few people and you got access to it, that's illegal. It's about insights which are there for anybody to see if they only go down and do the analysis, but they haven't done it yet, or they're too lazy, or they haven't spent the time spending on that. And this is something that I think the value picker guys have been doing for so many years. And there are some wonderful threads on value picker which talks about exactly this point that I just made right now. So it could be scuttlebutt, but it's basically gaining insights about exactly what is likely to happen to this business over the next 3 or 4 years, which is not yet in the papers. It will get reported ultimately when the results come out, because think of the sell side analyst. He's covering 30 companies and all the results are coming out. Uske paas time hi kahan hota hai sab karne ka. Or think of the media reporter. They have to respond to the results that have come out, or they interview the management on some questions about yesterday's results or the result that came out just in the morning. But they just don't have the time. Even if they have the intelligence, they don't have the time to have those deep insights that you would have if you had to actually go deep dive into a business model, rip it apart completely, and then try to gain insights that will get reported eventually over time. That's what the game is about. That's what this is about, I think. So you have to think about this framework that I like is the signal strength framework. We are all familiar with the signal strength framework. Some pieces of data are completely noise. Some pieces of data are not noise, they are information, but their weight is small or negligible because they don't have the element of surprise. They only conform to what you already know. And there are some pieces of data which is either in the public domain or not, which could be immediately happening or maybe happening over a period of time, is so powerful, has such a high signal strength that is what you are trying to isolate and identify. And to do that, you have to know what not to do because of the distractions that are out there. If you're doing 50 things, then you would not be able to, very few people are able to do 50 things and still be able to zoom into that one little thing which is very high power signal for a given business. So at least I have not been able to do it. Things like slow things, There's slow changes that are happening. Again, one of the tricks that I use in the class to show students is to not show quarterly results or not even show annual results. Show the picture of the company 5 years ago, 10 years ago, 5 years ago, 3 years ago, 1 year ago, today. You will see change. You will notice change because you have removed, in fact, less information is more noticeable than more. You have more information, more data, people think, oh, I should get more information, more feeds, more access, more sources, ye bhi le leta hu, wo bhi le leta hu, subscription, this, that. This will inundate you. If you want deep insight, you have to actually be able to see overall long-term trends. And when you see long-term trends, the short-term noises, using moving averages or using multi-period averages instead of so there are seasonal effects and there are quarterly effects and there are bad quarter and there is inventory pile up and there is a reduction. If you keep looking at these things on a quarterly basis and look at the con calls, they keep talking about nonsensical questions for the most time, you're going to miss most of the most important stories. The most important story is in the long-term trends that is playing out, good or bad. And that is noticeable only if you actually remove a lot of the data that is clearly there but is mostly noise to get to the signal. Maxim 10, this is the last one, so you can be happy, it's almost lunchtime. This is the one I've had trouble with, to be honest. He says errors of commission should be weighed the same, not higher, but the same as errors of omission. Now, we all know that errors of commission show up on the P&L. And I'm not even talking about situations where you're managing other people's money. Let's forget about that because that makes it very obvious that you cannot weigh errors of omission very highly. You get paid for what you have done. And nobody's going to, nobody will even find out what you thought you could have done but you did not do. But you know what you could have done or you did not do. And you know that you could have bought that stock, it was well within your understanding, but you passed it because it was 3% higher than what your purchase price was, and now it is 300x of the price that you refuse to pay for it, and for all the right reasons. So I want to talk about managing your own money when you don't have other people's money to manage. You're only looking at yourself. What he's telling you is if you remove the agency problem, you should weigh errors of omission as severely as errors of commission. It's almost like loss aversion. You should treat losses and gains as if they were the same. That's what loss aversion tells you. He's talking about even errors of omission. He said it doesn't matter. In the long run, he says, he calls it omission bias. Humans seem to be programmed that way. Errors of commission generally get weighed more heavily. Richard and many other scholars argue that we should make efforts to give them the same weight. Some work suggests that actions or errors of commission generate more regret in the short term, but inactions or errors of commission produce more regret in the long run. And we've all gone through that. Things that we could have bought, but we did not buy, are now selling, or things that you sold out, but that's an error of commission. Selling out and then seeing it go up 100x is actually an error of commission because you actually consciously acted and sold something. But let's talk about errors of omission, that something that you could have done but you did not do, which did spectacularly well. Now here I just want to add one nuance, which is the idea circle of competence. You have to define what kind of an investor you are. Because there will always be some activity, even within the field of value investing, which is doing so well, which is outside the circle of competence. It could be investing in, let's say, a turnaround situation. It could be investing in penny stocks. It could be investing in commodity businesses. Something, if you choose not to do, should not become part of your opportunity set. So if, for example, I choose to invest in businesses which I believe are good quality businesses, available at reasonable valuation, run by great management, have scalable business model, something that I mentioned earlier, and yet I don't do something that I could have done, that's an opportunity cost for me. That's something that I should learn from. And that's a mistake that I don't want to make, and I should try not to make in the future. So it's important to define the circle of competence and not get too envious about some other guy in your own profession doing very well in something that you wouldn't have done in the first place. So I leave you with that. I'm still struggling, to be honest. I do agree with all the other maxims. This one I'm still struggling with yeah, Donald.
Sir, if I could just put it there, or not was, or wasn't there, let's say in 2016 to 18, everything you threw with a dart was doing well, and then people's portfolios were corrupted totally because a lot of the excesses also came in the diligence. And then 2018 onwards, because everything was priced to perfection or more, only thing that worked was businesses which had operating leverage hugely big. So I know friends who were very focused, like Anand on operating leverage. They were the only guys who did well in that time frame. Did perform way better than what others did. And then we know what all happened in COVID situation that time. So markets keep changing, and your style has also to be more adaptive. So what do you think about that part of breaking this circle of competence? With, of course, we have the advantage that we have such great investors with very different styles in our group.
So
it's easier for us.
So it's a mental construct, right? Circle of competence. Basically, it is admission of humility that I can't do everything. So I have to find a way to limit myself to things that I think I can be good at, and I want to either. There's a famous story about a friend of Charlie Munger who has made billions of dollars in real estate by only focusing on something like 5 square miles around the Stanford University campus. That's all he has done. He hasn't done any other real estate. He has become good at only investing in real estate in 5 square miles around the Stanford University campus. So that's a circle of competence. It depends on if you are doing very well in a very narrow field and you thoroughly enjoy it, there is no reason for you to do anything to increase the circle of competence, because unless the competition comes in and that opportunities that you had, okay. But at the same time, money is not everything. Sometimes you want to increase the circle of competence not because of the money, but also because you want to learn, because this is a profession where we learn a lot, and just the thrill of learning about a new industry is enough for somebody to have the motivation to increase the circle of competence. I think you are coming from that direction. So you could define a circle of competence in terms of industries that you want to operate in and not operate in. You could define a circle of competence in the style of investing you want to do. You are a momentum driven investor in value investing, or you are a mean reversion investor. You could choose that, or you are an investor only in micro caps. We have friends in your in a value picker community who just love the process of investing in uncovered potential future gems. And sometimes when they turn out to be right, they are spectacularly right. And the thrill of being the first one or one of the first ones, or to see the institutional following that comes much later, is got its own sort of psychic benefits as well as monetary benefits. So you could define it from that angle, or you could define it that there are certain industries that I will not touch. For example, I will not touch real estate because there is a seedy side to it which I don't get to see. I only get to see the front end, पीछे क्या हो रहा है politicians के साथ and all that. वो कभी नजर नहीं आता तो मैं नहीं करूँगा. So I know people who have defined their circle of competence in many different ways. So I'm fine with that. I'm also fine with defining a circle of competence and then working towards increasing the size of that circle, which is, I think, what you believe in completely. But it doesn't have to be like that forever for everyone. It is totally up to you as to how you want to do that. And then there are people, I've seen people have combined, for example, technicals with fundamentals. We have some wonderful value investors who have done very well by combining technical analysis. You know, that's what the whole thing is about, that you understand that when people are trying to compound the money in financial markets, there are many ways of doing it, and value investing just happens to be one of the ways. And even within value investing, there are so many ways, but there are other ways which are not value investing. For example, technical analysis, and there are things that you could learn, and you could learn from the trading community also. There are successful traders out there. So the point is that how you define your circle, what kind of nuances you add in that circle is totally your call. In the end, it has to work for you. It has to give you joy. It has to obviously make you money. I don't think it will give you joy if it doesn't make you money. But even if it makes you money, you may find joy in enhancing that circle, and so be it, and so you should try to do that. Yeah. So by the way, let me just complete this. These are the maxims that we talked about. He's divided them into 5 categories. I picked 12 out of them. The number 4 is actually the section 4 is very technical, and it's more to do with government policies. I left that one out, and last ones I left, they're all personal. So they are actually quite useful, so you should read the book if you haven't. Apply these things. So that was it. Thank you.
So we have time for a few questions and answers. Please ask for the mic before you ask a question.
So you were going to show something about ChatGPT.
वो तो दिखाया था
Chat. Apart from that, you said there's some other things that how you frame your questions and other things.
Oh, I'll do it separately with you. Because if I open that ChatGPT, it will open the window where there are all these things that I've done which will be visible. Some of them are very personal.
Apart from your investment, we learn a lot of technology from you. I said apart from investment, we learn a lot of technology from you.
Ah, that's good. Yeah, I love technology. But if you want to learn fashion, you have the right guy here. By the way, Safir and his very close friend Samir Arora, they met me many years ago, and they changed my perspective on luxury goods companies. So we had a very interesting conversation sitting in a Oberoi hotel, if you remember, the brief one. But I went back and I studied Ferrari and I studied LVMH, and I was completely blown away. And I found that and the number of people who you need in a year to spend this kind of insane money on these things, it basically opened my eyes on how deprivational marketing works, why LVMH and Gucci's and Hermes, I don't know how you pronounce it, they burn their bags. And I met this girl in one of the flame selections. He says, sir, you don't know, there's a 6-month waiting list to get this bag. Yeah, something like that. They're insane. Look at the performance, and they're completely recession proof. And COVID came and went, and the Ferrari continued to make. They make 10,000 or 12,000 vehicles in a year, which is 1/3 of how much Toyota makes in a day. And if you look at the stock price chart of the two companies, you will find that they are like so different. And Toyota is one of the best companies, the most popular car brand in the world. So I was very fascinated after our conversation that I had with you and Samir about luxury goods companies and how they could be phenomenal businesses also, even though they don't meet basic human needs, but they meet basic human wants, aspirations and wants. And there are enough people out there, and we make fun of people who buy these things, and then Safir goes around in wonderful sports cars, and he doesn't make fun of that. Okay, so yeah, so have some Q&A, please.
Yes.
Who is the person? I can't see. Yeah.
Coming back to the initial slides, you talked about when it comes to a company, cash flows, ROE, return on capital invested, all these metrics, and valuations, of course, profits, earnings, that's what matters. But I'm relatively new to the field. But what I've seen is, I just want to know your thoughts on this. Whenever there's severe corporate governance issues, corporate governance meaning you cannot see it in the numbers, you cannot see it on the margins, you cannot see it on the balance sheet, nowhere. But I've come across companies that you have a murderer sitting on the board. You have a promoter that is consistently doing tax evasion, who's being impersonated.
But how do you say that you cannot see that? Because anybody who is financially literate and is analytically inclined would see that, right? It will show up in the numbers.
Mostly we find these details in DRHP or like news information, like you rightly pointed out. But business is booming. You got a company, income tax evasion, I tell you, okay? One company, the promoter has done insider trading. SEBI has fined them, and he's doing tax evasion. And they produce a very unique chemical that's used for semiconductors, and they export it to China. Margins 25%, you won't find that in the specialty chemical space, like 25-28% consistently. And stock price doesn't do a thing. P multiples are 10, 15. So, what is your perception? Like corporate governance, these things do really matter, provided that the business
The metaphor I would use is that of a tijori. There's a lot of money in it, and the person who's looking after it's your wealth partly in it. Person who's looking after it has the keys, and you're not at home. You're not at home, so he can take it away, and you can do nothing about it. So the problem in governance is that if the moment you start putting yourself in the shoes of the owner, junior partner in a business which you do not control, have no influence over, you have a senior partner who calls the shots, then from where I come, other things don't matter. How good the business is, what it will do, it doesn't matter, because I'm not going to benefit. There's a very high chance that I'm not going to benefit from that. And more importantly, the market knows all this. If the market knows all this and it's a crooked company run by crooked people and the market knows it's run by crooks, then what is the chance that even if, forget the business part of it, I'm not going to get anything out of this, but the market will also not see it. So where is the logic of looking at this situation? Especially when the opposite end of the spectrum, when really good businesses run by really good people are also available, and once in a while they become available at fantastic valuation. Where is the choice here? There is really no choice, in my view. Why are you attracted? Just because the business is moving? There are so many other businesses that are moving where we don't have the governance issue, and you have the valuation. So why are you attracted? Because there is.
It's a very unattractive trait.
Okay. So I wouldn't do it, but then somebody might say, because it's a fraud and the stock has dropped and too much and the business is doing well, it's a 3PE stock. 3PE stock could become a 6PE stock. It will do that. A friend of mine, even Safi knows, is probably invested in that, was invested in a company which was allegedly involved in the Augusta helicopter scam, and there were investigations and the stock got hammered. But look at the business. Look at what they've done. The business, we talk about KRBL here. So some people really don't care. They focus on the business and they think this problem will go away. It hasn't gone away. At least in the perception of the market, it hasn't gone away. At least significantly, it hasn't gone away. Because if that problem was not there, this stock would be selling at a 25p multiple kind of a stock. It is like an FMCG company with a branded business with pricing power and a basic human need. But it is what it is, and some people will totally disagree with me and would do that. I would say that will make it. So it is totally your call. But what you described to me was actually much more serious than the issue that we are talking about in this KRBL situation, and therefore I wouldn't go close to that. If anybody wants to disagree with me and give arguments in favor of, by the way, ChatGPT is a great place to find counter arguments. So if you want to ever get into an argument with your wife, before you get into the argument, get that app. So give me counter arguments against something, and it will give you 4 or 5 reasons why you shouldn't be doing it or should be doing it. Anyway, so if anybody disagrees with me, please come forward and give your counter arguments.
Sir, but there is also a perspective where you have the business is actually supported by something like they have quite a lot of visibility when it comes to government contracts and stuff, which are pretty long-term and sticky in nature.
Okay. No, the question is this. There are 2 things here. The probability of success and the probability of the success translating into stock price appreciation. The latter one is dependent upon perceptions. The former one is dependent totally on the business. If you invest in that situation, you are betting that in the long run, the perception will change. You may be right, you may be wrong. If you're right, and if the governance issue is perceived by the market, even momentarily, to be not a big issue, it could happen in a raging bull market, you can make money there. But my point is, there will be stress. While you're invested in a business run by a crook, maybe a great business, but run by a crook, you are a junior partner in a business which is run by somebody who is not having the good governance standards that you would look for. Then it's up to you whether you can sleep at night. Every day I will give you a lot of pain and stress, because the market will take a long time to ignore this particular aspect of governance and will then re-rate the stock, unless the fellow actually reformed completely on his own and genuinely, and the market believes it. So those are all a lot of moving parts. So you can give that probability. There's a 90% chance that he will fix, and he will genuinely fix, and he will, and the market will see it too. And there are no more cockroaches in the kitchen, and this problem will get wiped out from the memories of the public, because it's an old problem and the business has become better and better and bigger, and they have got governance in place, and they've got professional management in place, and so on. So anything can happen, but it will be a long haul. And while you are invested in the long haul, there will be other opportunities that you would not be able to invest into, because your capital is tied up in this particular situation where you don't have those stressful situations, where you don't have. This was the only choice you had versus bonds is different. One of the maxims is basically, when I should have talked about it, but I didn't. Number 11, don't be limited by the options that are in front of you. See, you're in the capital allocation business. You're not in the business of being invested in this one little company. You have a choice. We are capital allocators. We can buy anything. We can sell anything and buy anything else. So our choices are not limited. We have many more choices. So to remain invested in a business is also a conscious choice. You're effectively buying your book every day. You're selling it and buying it mentally. So you are doing that, but there are other choices out there. So if you don't compare other choices, where you don't have this stressful situation, where there is no governance issue, where the business is still fantastic, and maybe you're paying a little more higher price, and maybe the total money you will make will be less, then in a stressful situation, is it worth being in a stressful situation? Some people will say, no, it's not worth it. Some people will say, yeah, मेरे को तो पैसे से मतलब है. Who cares about the stress? So it's up to you.
But can we say that, say something like a public sector bank might prove an exception? Because, for example, say even if you see before COVID, when there was like PNB was kind of involved in governance lapses, and there was quite a lot of hammering around public sector banks, and now you see their performances.
What about that? See, you're asking about personal preferences. Everybody will have their own personal choices, and they will justify that for themselves, but they can't justify it for the other people. You can argue it both ways. So this is where you don't even need a chat GPT to come up with counter arguments to not do PSUs, not to touch PSUs. If you don't want to touch PSU banks, don't do it. Some people don't want to touch banks. In fact, I think Sridhar and he said, I don't want to touch banks because there is so much opacity and I don't want to do that. So they've done very well without touching banks. If something is working for you without doing a lot of things, you don't have to do those things. It's totally your call.
Sir, I asked this about corporate governance issue.
Who is the questioner? Yeah.
Because so many small and mid-cap companies are facing this issue in India.
Why, I think there's a prejudice of governance only against small companies. Even large companies, very large companies have governance issues. In fact, if you look at the governance issue market caps, it will be much more in larger companies than in smaller companies. So I don't want to say that small guys are crooks and the big guys are not crooks.
Clearly after this week and last week.
Yeah, there's a mic.
So my question is around some risks in businesses that are 0 and 1. Kind of, let's say, take an example of Page Industries, and what if the jockey cancels the license?
Yeah.
So there are, what are your views on that? And similar is the case.
See, one of the things about life is that you only see one parallel universe. You don't see the alternate histories that could have played out. You could compare Page Industries with Astral. Astral broke up with Lubrizol, right? And has done wonderful things beyond over there. But Page Industries had a Damocles sword on their head, and they actually went and did renew the contract. But there was always a possibility. You didn't see that, but the possibility existed that it could get cancelled. Yeah, you may argue that why would Page cancel? It's not rational. Then you are betting on rationality of people, which is not what I actually believe in. People do dumb things all the time. They might say, "हमको खुद करना है," or Apple might say, "I don't want to go direct." Reddington is highly dependent on Apple, and Apple says, "I want to go direct," and they're trying to do that. So tomorrow you might see an announcement that Reddington has broken up with Apple. These things can happen. So you only get to see one of these. So when you say it's either or, you get to see one, but that doesn't mean the other thing couldn't have happened. So you have to play. This is the problem with social science. You can't do controlled experiments. to figure out what would have been the outcome if the other history had played out. Yeah, you're seeing the outcome of page doing well so far because the bad history, that alternate history, did not materialize, but it could have materialized, sure. So how to deal with that? You may decide by saying, I don't want to do this, or I'll deal it in position sizing, or I'm almost certain that this is not alternate history that is going to play out. It's your call. It's really your call. Your outcomes will be known. The process is totally up to you, what you choose. You may decide that there is a risk, it's a big risk, and therefore I will deal with this risk by either not by buying it at all or by sizing it appropriately.
The entire 48,000 market cap is based on this assumption.
Pretty much, because who would buy? Because it looks as I'm not brought unbranded ones. I would imagine that they are the same. So why would people not? Why would people buy the same product if the jockey name is not there on them? Yeah, sure, brands matter. We have the if I say brands don't matter, I won't get home today. Huh?
Not back to being your neighbor.
You are? Yeah. Okay, I didn't know that. Okay, cool. Yeah, so I think we can have maybe one or two more questions, and let's just end this.
A very small question. What is your thought on portfolio diversification? Like how many stocks?
See, this is again a question about which there are so many answers.
The second part of this, I mean, how much capital would you be comfortable allocating to a very high conviction bet where you're like, okay, this is the holy grail and this is going to be good. So, what kind of a percentage would you look at?
I don't know. Depends on whose money you're managing. Your own money, somebody else's money.
Your own money. I mean, if you talk about your own money.
And again, depends on when. When I was young, I had 50-60% of my money in a single stock. Today, I don't. It depends on your own evolution. So really, I don't want to give you an answer which makes you impressed with the answer, because these answers will come to you on your own. You can't. There are no right answers on this one. You can argue in favor of highly concentrated portfolios. You can argue in favor of very well diversified portfolios. I think Safir is in favor of that, so as is his friend Samir. You can argue it both ways. So I don't want to give you an answer which there is no right answer. You will get to know, and your own evolution. You will yourself evolve over time on this. Your thoughts will change on this over time as well. Yeah.
So the question is about the multiplication rule that we talked about.
Yes.
So the way we looked at 5 independent events and 10% each probability, is that how you calculate for favorable outcomes as well? There's a 41% chance that things can go wrong. Is that how?
See, you don't do the math. Okay, now this is the important, the wisdom of these ideas is not in actually trying to do the math, because then you are doing mumbo jumbo. The wisdom of the idea is the more the number of moving parts, the more the chances of something going wrong. The chance of one thing going wrong, one of the few, because they're independent, any one of them can go wrong. Even if one of them is remote chance, the probability that at least one of them will go wrong is very high. And that alone will sensitize you to the riskiness of the situation, instead of actually doing the number. The number crunching is only to help you recognize that things that look very low risk actually in aggregate became not so low risk, because any one of them could happen and they are remote, but combinatorial probability gets to 41%. It's more about directionally. Same thing applies to Bayes' rule. You can't get into actually applying these probabilities, but you are directional. You have a view. Is that view getting strengthened or weakened because of the new information that you have? Is that information relevant or irrelevant? Is it reliable or unreliable? Is it signal or noise? And should you and how do you act on that? Should you increase your size, or should you reduce your size, or should you keep it the way it is? Those are the things that will come to you when you think about these things directionally, instead of actually doing the number crunching on this thing, on a very subjective basis.
So directionally only, is that how you look at optionality on the positive side?
You have to give me an example.
Yeah, so for example, while analyzing a business, there are 4 to 5 different outcomes on the positive side.
Where's the microphone?
there are 4 to 5 positive outcomes that you're seeing that can happen to the business?
Any one of them could happen and it'll make you a lot of money, and they're independent.
Yes, yes. The possibility of making money is high, but the probability of any of those happening is quite low.
Okay, so that's like a VC model. That there are lots of bets, uncorrelated bets, lots of bet, asymmetric payoffs. So yeah, you would do that with a lot of diversification. Yeah, sure. Nothing wrong, but you can't put too much money behind a single idea. Some of the best bets in VC world have been like $1 million becoming $1 billion or something. Because you only see the winners, you don't see the losers, because most of the bets don't work out. Last question, please.
So my question, like there are two types of corporate governance issues we see generally. So one is a promoter-driven company, sometimes it is a management-driven corporate governance issue. So what I have recently figured out in the recent past, I'll say, so whenever there is a management-driven corporate governance issue, it is generally an opportunity to buy in.
You mean management in the professional management?
Yeah, professional
okay.
Management.
Okay.
And whenever there is a promoter-driven issue, it is kind of very deep-driven and it generally points other way around. So like we are also seeing some recent changes in. So what's your take on that and what's your experience?
See, without knowing the specifics of what you're telling me, I think I would tend to agree, because promoters can't be dislodged if they have controlling stake. But management which has done something wrong can be replaced. A person who has done something wrong can be fired, or has made capital allocation mistake can be replaced. But because he doesn't control the company, and therefore other things remaining the same, I would sort of agree with you on this. That governance issues are likely to be fixed much more quickly in professionally run companies, provided the intention is there to fix it. But the intention is not there because they're siphoning money out, they're promoters, and you can do nothing about it. Then, because they control the stock, they have majority control or effective control on the business and the directors and board of directors and whatnot. So if you can't do anything about it, as a minority, basically the question to ask is, can this persist? If it persists, is there anything I can do about it? So in a professionally run company, the people who are and management is honest. The professional has done some crooked behavior, he could be removed very, very quickly. He or she could be removed very, very quickly, and that matters. So I'll give you an example. Recently, a wonderful company called IRFC, the promoter, the CEO was just fired summarily by the government for something he did many years ago, removed, but doesn't matter. It's a 10-man company and they are an investment bank for the Indian Railways, and it's the business model worth studying. Did a case study on that in Flame recently, but doesn't matter. The business continues because the guy is gone, because it doesn't matter. The moat is not in the person, it's in the business. So it depends. A crooked guy could also be a wonderful capital allocator. He could take away, he could be an investment banker, he could be a guy with connections, he walks away with customers and whatnot, then you have a loss. So it gets messy. As you add more nuances, it will get messy, but from what you told me, typically governance issues in professionally run managements, businesses with professional managers, where they don't control the stock, should get fixed far quicker than promoter-led companies and family-owned businesses where there is no intention and they control the stock, so you can do nothing much about it. Because activism can't come in.
So means, if you look at the example of recent, something happened with IAIP or it was with Infosys also. And then
what happened in Infosys? What was the problem in Infosys? It was the allegation. It was a non-issue as far as I remember. ICICI was different. It got fixed.
Right. But other side, if you see Yes Bank or DHFL or some.
They got fixed too. The guys are gone. The promoters are gone. The equity is gone. Now got new management in place. So problems get fixed. The question is the governance issue. Sometimes the entity survive, but the equity goes to zero, which is a deserved outcome in capitalism, by the way. You are equity owners. Why should you be bailed out? And that's what happened in many of these situations. So governance issues, when they manifest, will take down everything, including the minority shareholders. And that's the way it should be. Why should they be bailed out? Yeah, but the institution could survive because bank largely is actually public money institution. They have taken public savings. So you want to make sure that the if you talk to HDFC and all these quota guys, first thing they talk to you about the fiduciary responsibilities they have toward the depositors. They don't talk about shareholders. They talk about depositors, that I have this money, I have to protect this money. It's other people's money, because it's 90% other people's money, 10% your money. So that intentions are good has to be seen. But the governance is bad, no matter what kind of business model you're looking at. You shouldn't expect good outcomes out of bad governance.
Maybe if I can slip in one last one, if you allow, Sanjay.
Okay.
First of all, thanks for the lovely session. I really loved it. My question is more on the valuations, and it's in comparison with the world. But if I look at any company or any industry, and let's create a hypothetical an example here, that an industry trading at a 12x multiple now versus 17x in 2018-19 pre-COVID, just ignoring the COVID period. How do I know? Is there obviously there is an art behind it that you just have to close your mind and close your eyes and think whether what multiple I should be paying for this company's vacuum, just an absolute multiple. But is there a scientific way of thinking that's just a metric or something to really understand whether 12x now is cheaper than 17x before?
No, there isn't. Because interest rates also change. So when you are valuing something at a given interest rate, your implicit assumption is कि ये तो उतना ही रहेगा. Because once you start introducing nuances that interest rates will go from 6% to 16%, then how do you do the valuation? When your discount rate is anchored to the current interest rate, whether it's high or low, there is an implicit assumption that that's how it will going to be, but that's not how it is ever. So I don't get into all that. Actually, I don't get into DCF. I'm very much in favor of protection versus prediction. And if I had to make predictions about where interest rates are going before deciding whether to invest in a business or not, then I probably shouldn't be looking at that business.
Not just the interest rates, actually. Just, I'm sorry if I
multiples. Yeah.
It's like, so I like a company, for example, and then I might be tracking the company for so long, but it's just a valuation question. That valuation wasn't enticing enough for me to get in. So it's always on my radar, but now that 17x earnings multiple is now 12x.
Yeah, but because the opportunity cost has also changed. So the way to,
what that 12x should be now, that should be a 6x for me to get enticing. It's a new world, right?
Without going into the answer to that, they will give you the method for that. Put yourself in the shoes of a businessman who has got two alternate opportunities. Putting money in a high quality AAA rated bond, on which you put $100, which will give you a certain interest income, and that won't increase or decrease. You have almost certainty that it will not increase or decrease, and then there will be inflation which will eat away into that particular coupons, and you will be ending up with some return over a period of time. That's one choice. The other choice is you have a business where you can put $100. You can also invest. It will produce some earnings, and if the business is good, it is the inflation hedge, and the earnings will grow, and the internal rate of return on capital employed is high, and there are reinvestment opportunities, and there is good capital allocation and good governance and all of that. And if you buy it at a valuation which is even more expensive than the equivalent bond valuation, if you hold these things long enough, the outcome in the second case will be far superior than the first one. How much in your model you can keep increasing the price to find out at what point it makes the bond better than the business. So the bond, it's static, right? You know exactly what it's going to pay you. But the stock, my preference is to find those businesses that you're referring to at valuation which is similar to the bond, or only at a slight premium to that bond component, where I have a high degree of certainty that in the long run, if I hold on to this, if these assumptions keep materializing, then my outcome to be a business owner than to be a bond owner will be far, far better, because I haven't paid a big premium over the bond component. I'm not really paying much for growth. I'm actually not paying anything for the uncertainty, the good side of I'm buying into uncertainty on very favorable terms. If I'm doing that, and if I do this 8 or 10 times, then my overall portfolio should do well. Even though this particular one situation that I'm looking at may not work out very well, but if I do it 8 or 10 times, then overall I should have a much better outcome, considering odds.
Thank you.
You're welcome. All right. Thank you so much.
Thank you very much. Very insightful session. I think I would rate it one of the best that I've attended, which have been quite a few. But
okay, that means there's scope for improvement. Every time I get better.
Yeah. lots to unpack, and I would definitely watch it once or twice again when the video is released. And a small token of appreciation from our side.
Thank you.